I think the hawkish tariff stuff is already in the price.
The market trades Trump as a yield curve steepener.
The reality is the market has looked past a lot of the geopolitical risk.
When we talk about exhaustion, we're talking about really high sentiment. You're pricing in all of this good news.
NVIDIA is the #1 high quality stock. So we want to continue to embrace quality.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City for our audience worldwide. Good morning, good morning. Bloomberg Surveillance starts right now on a 2-day winning streak on the S&P 500. Your equity picture looks a little something like this. Equity futures on the S&P up by 0.06%. On the Nasdaq 100, pretty much flat and unchanged, up 0.03%. The two names you need to watch through the next 12 hours. One is Target, a little bit later this hour, earnings dropping from them, and Nvidia, the big one, after the closing bell with 68 buys, 6 holds, and 2 sells, embracing a ton of career risk.
All I can say is anyone who's saying sells, these are the statistics that I'd be looking at. In January of 2023, Nvidia earned $4.4 billion over the preceding 12 months. This expectation for this earnings season is for them to have earned $61.4 billion over the preceding 12 months. It is a sea change for a company in an unprecedented rise in earnings at a time when this potentially could be the new railroad.
In many ways, it is the equity market. This came from Bank of America. It remains the most dominant stock in the market, driving 20% of the S&P 500 return over the past year. Expected to drive nearly 25% of the S&P 500's EPS growth in the third quarter.
I mean, basically the issue is people say it's an expensive stock given how much it's gone up. But then you start seeing the growth in profitability over the past 12 months, over the past 24 months. And all of a sudden, people make an argument that it's cheap. We don't even understand the seismic shift that NVIDIA represents or what potentially it's cashing in on. And that's the reason why a lot of people say this will be the ultimate gut check at a time when yesterday, amid all of the gloom and fears of nuclear war, NVIDIA shares were up 4.9%, and that lifted everything along.
Might as well be long. NVIDIA's up in the pre-market by 0.1%. Do you want to talk about Game of Thrones? Let's talk about Game of Thrones. President-elect Donald Trump nominating Howard Lutnick to Commerce Secretary. And this is the quote that stood out in the press release. This is what he said. He will lead our tariff and trade agenda with additional direct responsibility for the Office of the United States Trade Representative. That's a big job.
It is a big job, and there's a lot of questions about this. Does this mean that now the ambassador of USTR reports up to Howard Lutnick? This is a signal now to anyone that wants to do a trade deal with the United States. This is the man you would need to talk to. It reminds me of 2016 when Wilbur Ross came in. He was really at the helm of those trade negotiations, but then pretty quickly you realize the individual that really understood the legality of trade was Robert Lighthizer, and then it quickly moved on to him as the main man behind trade. So a lot of questions on what exactly this means, because it looks like he has an expanded portfolio beyond commerce.
Okay. Legality, schmagality. I think that there is this question at a certain point of what people actually want to get done. And is there a cohesive strategy here? What is that cohesive strategy and how is it going to get through? And I think ultimately, the legality, I mean, okay, we can negotiate this and figure out what's going to happen. But the bigger picture is, what is the strategy? Because that, I think, isn't so clear sometimes.
The guiding light for a lot of people, cabinet appointments. This was the strongest signal yet of how seriously they're taking tariffs when they come into power in the next few months. This is someone who sat around the table and had a conversation with us about tariffs, someone who went to Madison Square Garden and reflected on 100 years ago of there being no income taxes and all we had with tariffs. We asked a very blunt question around this table. Will there be carve-outs? Will Apple get a carve-out? What did he say? No, they won't.
No, he said no carve-outs. He basically was talking about taxes, tariffs, and how maybe in the past you saw these waivers given to certain companies when it came to tariffs. That's not going to happen. According to Howard Lutnick, and now this individual is at Commerce, this liaison between the government and private sector, but then also have this broadened portfolio. He seems to be the man behind Donald Trump's tariff agenda.
Anne-Marie's reporting. We're going to hear from Kevin Walsh and Apollo's Mark Rowan down in Palm Beach, Florida. Not us, the President-elect Donald Trump interviewing them both a little bit later. Coming up on this program, we'll catch up with Julian and Emanuel of Evercore ahead of earnings from Nvidia. Ed Mills of Raymond James as Trump's search for Treasury Secretary continues. We'll catch up with the retired Lieutenant General Robert Walsh of Academy Securities on Russia-Ukraine tensions. We begin this hour with stocks rising as traders await Nvidia earnings after the closing bell. Julian and Emanuel of Evercore saying the bull market isn't over, but there will be volatility ahead. The relief that the election was clear and uncontested has given way to a correction that acknowledges the geopolitical, policy and interest rate-driven strategies ahead in 2025. Julian joins us now for more. Julian, good morning to you.
Good morning.
Let's talk about some price targets. BMO, 6,700, 2025 year end. Goldman, 65. Morgan Stanley, 6,500. You think mid-2025, 6,600. What's behind that?
So we think there's a lot of parallels in the way the market has digested the election and moving beyond to not President Trump's first year in the first term, but the second year of the first term. Think about that. 2018, the year of tax cuts, the year of tariff and trade wars, and the year of gently rising interest rates until they rose a bit too far at the end of the year. That's what really makes sense to us. And then, of course, the other part of it is a Fed that would like not to be at loggerheads with the president, but the data and the policy where inflation and growth may be going may cause them to have to sort of ease up on the rate cutting as opposed to the counterpoint where they were hiking in 2018.
In the days after the election, in the immediate aftermath, you speculated on the prospect of a melt-up in equities. The rally has since stalled somewhat. What's your view on that now?
I think there's a digestion phase going on, processing all the change. Look, the American people voted for change. We are getting change, fast and furious. And there's clearly a bit of it. I think the other aspect of it is that going into the vote, the very clear preference among our clients was to see a divided government. But you have the unified government. The mandate is to move fast, and that means more volatility. And again, there's a lot of uncertainty about how policy is going to be implemented. We talked about those dynamics. And there's a recognition that the bond market is going to call the tune for the next year at least.
That's what I wanted to pick up on. That was the expectation, that essentially you can say whatever you want and try to find whatever loopholes, but ultimately the big check is going to be the 10-year yield that's going to come in and rule the roost. We haven't seen it rule the roost. In fact, the rise that we've seen in yields has not impeded at all the rally that we saw post-election. At what point does it actually start to exert its pressure?
So if you look, the last week or two, the bond market has been a bit better behaved as we're trying to digest this all, and we've stalled out below 4.5 on the 10-year yield for now. We think if you start moving towards 4 3/4, and then, of course, the cycle high is at 5%, and that isn't our base case at this point, because, frankly, what we think when the Treasury Secretary is announced, whoever that person is, it will likely be a person who understands the dynamics of the bond market and the need to project policy and concern there, because frankly, as the bond market is moving, that tells you how far you can go, as it did in 2018.
Is this a paradox? Somebody who is going to be a Treasury Secretary that gets some of these policies across, that also is sensitive to the bond market?
There's a lot of constituencies to please, and the main constituency is going to be the occupant of the White House starting January 20th. It's a very difficult dance, made even more challenging by the fact that as good as this bull market is, we have to acknowledge that at 25 times earnings, stocks are expensive, which is why we've seen the volatility of late, because any news that sort of disrupts the narrative can cause volatility.
Well, Julian and John mentioned it. My reporting overnight with Saleha Mohsen, Nancy Cook, is that Kevin Walsh and Mark Rowan will be down in Palm Beach today for interviews. Scott Bessent is also still in the running, and then Senator Hagerty is kind of in the mix, maybe a dark horse candidate. Those four men, will they be sympathetic to what you're talking about? Will they understand the market dynamics?
I think the market interprets the answer to that to be yes at this point. And I think the reason that this has taken longer than expected is to fully appreciate the difficulty of the dynamic and the importance of making sure the bond market doesn't run away so the policy initiatives aren't limited and we get the change that the country voted for.
When you're talking about, though, the 6,600 end of June 2025 for the S&P 500, at some point, are tariffs going to bite into that?
It depends how it unfolds. If you think about 2018, and look, the numbers that have been put out there, I think most people would acknowledge, are sort of bid-offer type spreads. And what you're likely to get is not necessarily those extreme numbers. And it was, much that way in 2018. At a certain point, again, I go back to the bond market. The president likes to keep score with the stock market, for sure. But the bond market will call the tune for the stock market as well, and will tell you how much tariffs will end up biting.
Let's talk about this market, NVIDIA, which ultimately is the market. On the S&P 500, it makes up about 9% of the S&P, about 9% of the Nasdaq 100, rather, and about 7% of the S&P 500. Should I be comfortable with that or uncomfortable with that? Does that bring you confidence or anxiety?
Both, okay, because you can't get away from the fact that the Mag 7 has been the driver of this bull market of the last couple of years. And you can't get away from the fact that the concentration of the top 5 or the top 7 stocks is, so far surpassed the bubble 2000 peaks that it's almost not even a benchmark anymore. It's just the way the index and investing have evolved.
Really, really mixed few months for semis. You can see that in the index. It's pretty messy, to be honest with you. NVIDIA is the clear winner of the year so far. Does the tariff story compromise that?
It could, okay? But I think what's going to happen is you're going to figure out, as part of the negotiation, a way to work around that. And if you think about that company in particular, any of the friction that we've had that's essentially been building for the last several years with China hasn't really been a major impediment to the progress and the AI revolution itself, which we think has a lot more to go.
There's a larger question here. Is Donald Trump going to celebrate the biggest companies, sort of the American champions, and have carve-outs for them and enable their growth and expansion? Or will there be an effort to break up some of the big tech, cater to some of the more populist aspects, the J.D. Vance kind of approach to a lot of these industries that have been the main drivers of profitability and stock returns?
I think, again, it's going to let's see how it evolves. I would say our baseline view is that you are going to get deregulation, which is actually going to spur capital markets and M&A. But in fact, what you might see is smaller cap companies, particularly those that don't have international exposure, that don't need to worry about regulatory regimes in either Europe or China, blocking any type of transaction. That's probably where, in which informs our view of liking small cap stocks. I think that's where that's going.
Julian, you're hopeful that we get a Treasury pick before the end of the week?
It would be nice.
Yeah, then we don't have to talk about this anymore. Julian Emanuel there of Evercore. Can I just say that Senator Hagerty stood us up yesterday, and then I put the TV on in the afternoon. There he is, standing with Elon Musk and Donald Trump.
He picked them over us. Do you feel spurned?
I feel hurt.
Maybe if we
Seriously
offered,
hurt by it.
if we had offered, some kind of UFC fight, if we had offered maybe a space landing with some iron claws, maybe he would have come. But we've got to work harder.
When you get an email that says scheduling conflict, and you see what the scheduling conflict is, you got to go see a rocket launch.
I knew exactly what it was as soon as I got that response. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. As you've been mentioning, the search for Treasury Secretary continues. Sources tell Bloomberg that President-elect Trump is holding interviews with potential picks Kevin Walsh and Mark Rowan in Florida today. Yesterday, Trump nominated co-lead of his transition team and former Treasury Secretary hopeful Howard Lutnick to lead the Commerce Department. Scott Bessent remains a contender for the post, with reports that he met with Trump at Mar-a-Lago last week. And to SpaceX, which launched its 6th test flight of the Starship rocket yesterday, but it did scrap its anticipated catch of the rocket's booster. Elon Musk and President-elect Trump watched the launch as it started its voyage through space from Brownsville, Texas. The Starship circled much of the globe before splashing into the Indian Ocean. And a storied career came to an end last night at the Davis Cup in the Netherlands. An emotional Rafael Nadal waved to adoring fans after completing his final match in professional tennis. Tributes poured in during the post-match ceremony from the likes of Roger Federer, Novak Djokovic, and Serena Williams. Nadal leaves a legacy as one of the greatest to ever play, winning 22 Grand Slams, 14 of those on the clay courts at the French Open. That's your brief, John.
Danny, thank you. I've shed too many tears over this, and no one else wants to hear it anymore.
Well, it's okay. Go ahead. You can cry. We're
Roger Federer yesterday with a beautiful tribute. Let's start with the obvious. You beat me a lot. More than I managed to beat you. You challenged me in ways no one else could.
Are you feeling a little emotional?
Okay, all right. I'll crown a commercial break. Up next on the program, fighting for Trump's economic agenda.
At the turn of the century, our economy was rocking. We had no income tax, and all we had was tariffs.
Is that a sneak peek of the future? That conversation up next from New York City this morning. Good morning. More numbers on the board. Goldman 6,500, Morgan Stanley 6,500, BMO, Brian Bowski 6,700 year-end 2025 on the S&P 500. Just spoke to Julian Emanuel of Evercore. He's looking for 6,600 in the middle of next year. Equity futures right now up 0.1%. Under surveillance this morning, fighting for Trump's economic agenda.
At the turn of the century, our economy was rocking. We had no income tax, and all we had was tariffs. We took down our protection. We took down our tariffs, and we turned instead and we taxed Americans. We're letting the rest of the world eat our lunch.
So here's the latest. Donald Trump tapping the Cantor Fitzgerald CEO to lead the Commerce Department and oversee the White House's tariff push, taking him out of the running to become the next Treasury Secretary. The effort to fill that position ongoing today as the President-elect interviews former Federal Reserve Governor Kevin Walsh and Apollo's Mark Rowan. Ed Mills of Raymond James joins us now for more. Ed, welcome to the show. We've got to talk about Game of Thrones and the appointments so far. What are the signals that you're taking away from the appointments so far?
So we have a number of people who are loyal to Donald Trump, folks that are hawkish on foreign policy, people who are going to be very aggressive on tariff policy. Now, as I look to the Treasury Secretary race, I want to see exactly who's in that role because the tax policies, the debt limit all come back. They need to have a conversation with Capitol Hill. And we need to see exactly how that person has a relationship with the Federal Reserve because monetary policy will quickly figure into all of this, John.
Well, Ed, when it comes to my reporting alongside some of my colleagues in Washington, D.C., it was obvious that Howard Lutnick was given the no when it came to the Treasury role, and now he's in Commerce. This is an individual who has been going out touting this idea of tariffs. What's going to be the push-pull with someone at Treasury like a Scott Bessent, Kevin Walsh, or Mark Rowan, all of whom have either had interviews with the president or going to have those interviews today?
Yeah, it's going to be a cabinet that was probably somewhat similar to the first administration, where there was a team of rivals to a certain extent. I do think that Howard Lutnick at Commerce does not signal that we're going to go weak at all on tariffs. But ultimately, the Treasury Secretary could be the person negotiating with Capitol Hill as it relates to tariffs in the tax bill next year. One of the wild cards for next year is, does Congress decide to legislate for the first time in about 100 years specific tariffs globally? It's a question that I get all the time here at Raymond James. There's concerns about the economic and inflationary impacts of those. But the congressional concern is that it costs a lot of money, $4.6 trillion to extend out the 2017 tax cuts, and tariffs are increasingly becoming a very attractive option. So there is going to be folks in the administration that are going to be pushing for that, probably some folks that are going to be pulling back on those reins. Trump, I think, is the deciding factor who say, let's do it.
When it comes to the contenders in the race, and we should also, for good measure, add Senator Hagerty, who was with Trump yesterday, into the Treasury race. Who is best fit for the role you're describing?
So if you're thinking about legislative experience, having Senator Hagerty would be the best person to kind of coordinate with the Hill. If we are most concerned with being that back channel communications with the Federal Reserve, Kevin Walsh, as a former Fed governor, I think would be someone who is very well received by the market. Scott Bessent, certainly kind of exceptionally well known by Wall Street and would calm some of the concerns within Wall Street. The thing I would highlight, though, about both Bessent with the other candidates, especially Walsh, is that these are fiscal hawks. These are folks that are looking to shrink the budget deficit. That fits in very well with the Department of Government Efficiency, DOGE. I just question whether or not what their goals here would ultimately match with the first administration of the Trump's term, where he wasn't someone who is a fiscal hawk. So he is putting in place some kind of fiscal austerity here. But once the market kind of digests that, if there is pushback to that, does Congress go along with that? Those are the open questions that I have, Anne-Marie.
When it comes to the announcement yesterday with Howard Lutnick, it expanded upon the commerce role. It said that he will lead our tariff and trade agenda with additional direct responsibility for the Office of the United States Trade Representative. Where does this lead Ambassador Lighthizer?
It's a really good question. And Anne-Marie, I got that immediately from clients yesterday at Raymond James saying, is Bob Lighthizer now out? Because is he going to want to report to Lutnick? And I think that's an open question. Now, the Department of, or the U.S. Trade Representative is an independent agency that historically has coordinated with Commerce. One of the questions I have is that at Commerce, there's 45,000 full-time employees. Are they looking to use the resources of Commerce to help out USTR? Are they looking to hobble what the USTR would be? When I look back at Lighthizer's term during the first Trump administration, he was really aggressive. So I would think you would want those expertise to come back, someone who's done this, who has been able to implement change, someone who can kind of go on day one and hit the ground running. So if we don't have Bob Lighthizer, but we have Lutnick in Commerce Secretary, do you actually have to extend out some of the timelines here over kind of the tariff implementation? I think it's once again, a pretty important open question that this market will want to really know what the answer to that is.
Ed, the Game of Thrones, The Bachelor, it's all very exciting. I want to make it more boring. I want to understand what the framework, what the goal is of these appointments, and then what the checks and balances are on that, namely the stock market and the bond market. And I want to understand the framework that you're looking at that will ultimately govern some of these decisions. Do we have a sense of what the overarching strategy is and just how much of a check the stock and bond markets can actually act as on some of the policies that come through?
Yeah, Lisa, I think the goal here is to go fast. I do think that when we look back to the first term, the equity market is a daily voting mechanism that Donald Trump loves to look at. And oftentimes, whenever it voted positive, he would remind us of that. Whenever we had volatility, I remind folks back in his first term over the U.S.-China trade fight, there was multiple times where the S&P 500 was off more than 20%. And then we had Donald Trump come out and say, we're making great progress and we're pushing markets higher. The big question for me is how much of it's going to be the equity market this time versus how much is it going to be the bond market? When I talk to clients at Raymond James, they ask, what is the binding constraint for Trump to be able to enact his agenda? And I think it is a move on the long end of the curve where we would be seeing kind of possible concerns of a second wave of inflation. Bringing up the cost of government debt would be probably the thing that would cause Donald Trump to pull back on the reins and tell his Commerce Secretary, tell his Treasury Secretary to do the same. So in Trump 2.0, I think the bond market takes center stage, where Trump 1.0, it was the equity market.
I heard exactly the same thing from Julian Emanuel just moments ago. Ed, appreciate your time, sir. Ed Mills there of Raymond James. This is the presidential put, the Trump put. Was the equity market. A lot of people making the argument now that it's now the bond market. Do you remember the phantom phone call with the Chinese all those years ago?
Anytime something was leaked that he didn't like and it potentially meant the stock market move, it was quickly renegotiated, or a phone call quickly happened to make sure the stocks moved in the right direction, which was up. I want to get a hat that says Mika, make yield curve great again. I think that that's going to be the way to go.
I don't think that's going to work. I'm just, I don't think that's going to work.
I'll discuss it. I'll go to different sporting events and I'll lecture about it.
See how it goes. From New York this morning, good morning. two-day winning streak on the S&P 500. Here's a snapshot of the equity price action so far this morning. Good morning to you all. We're up by 0.1% on the S&P, higher by 0.13% on the Nasdaq 100. The big one for the Nasdaq a little bit later, almost 9% of the Nasdaq 100. Nvidia reporting earnings after the closing bell, making up something like 7% of the S&P. That's Nvidia coming a little bit later. Any moment now we're going to hear from Target. Target in focus after Walmart did pretty well yesterday. Target dropping, Lisa, right now. And it's a huge disappointment pretty much across the board. We're looking at fourth quarter adjusted earnings per share of $1.85 to $2.45. The estimate was $2.65. The full year adjusted EPS coming in between $8.30 and $8.90 versus the estimate of the high end previously of $9.70. There is a real question across the board. Comp sales way lower. Sales just in general way lower. Inventory buildups that really seem to still hamper their ability to turn a profit. What strikes me, John, as we were talking about the beat and raise that we saw from Walmart, and is Walmart indicative of the rest of the industry? Well, is it a management issue? Is it a products mix issue? Or is it just simply how much a business can diversify so it's not as dependent on the fact that it is a retailer? As you said yesterday, Walmart beat and raise. This morning it's miss and cut. Cut the outlook over at Target. Inventory, we had this conversation yesterday. Managing inventory is really difficult right now. You're managing inventory in the face of what could be a port strike. We sort of skipped that hurdle earlier on this year. We still face another one in the middle of January. And then you've got the tariff issue on top of that. We've had inventory problems in the past at Target. Target's getting hammered now, by the way, by close to 13% in the pre-market. But it also seems the demand wasn't there either going into the holiday shopping period. This really goes down to the difficulty that we've seen during the pandemic and post-pandemic of understanding the right product mix. We're talking about the potential for clothes and home products, things that are not essential at Target, that they stockpiled ahead of that port strike, as you mentioned, John, and they're not being able to move it as quickly. It raises the question, how do you gauge the fast-moving demand at a time when you have to plan ahead to get ahead of some of the disruptions that we're talking about? It's a miss across the board for Target. We'll have this conversation with Chuck Grom of Gordon Haskett in the next hour. Target at the moment is down by about 12 or 13%. Under surveillance this morning, Nvidia reporting results after the closing bell. Revenue estimates from analysts covering a wide range spanning roughly $8 billion, reflecting uncertainty over supply of the company's latest chip lineup. It's not demand, it's about whether you can meet it. Yeah, basically, the idea here is nobody expects Nvidia to say anything other than demand is incredibly strong. And the question is just, what are their new innovations that they can come out? Also, how much can they keep raising their expectations? Can they keep being a moonshot in terms of just quadrupling and quintupling and et cetera their expected earnings going forward? To me, this is the market, as you mentioned before, and it could be the most important macro event of the day.
And there's a lot of questions about Blackwell, this new product. It suffered some manufacturing problems. So you look at the analyst notes, they really want to know details from management about when that's going to ramp up. BNP Paribas saying also following the, quote, insane demand management comments, we are keen to hear any data points that shape of the Blackwell ramp up. Where are they right now with this new product that maybe was facing a little bit of hurdles? Have they been able to ameliorate that?
This is the market. We're talking all about politics and the Trump Treasury Secretary pick, but this is the market. Well, this to me is the moonshot. I just want to repeat the numbers from earlier, and this came, thank you to Jim Reed over at Deutsche Bank, that in January of 2023, Nvidia earned $4.4 billion over the prior 12 months. The consensus for today, just $4.4 billion. The consensus for today, $61.4 billion over the past 12 months. I mean, it is hard to wrap your head around how much this is an expansion at a time when this company went from being essentially a video game processing chip maker to the linchpin for a lot of the technological advancement that we hear from every company across Wall Street. We've been on top of this theme for a while now. I still think the biggest issue for this company is the patience of investors in their biggest customers. And we know who the biggest customers are. It's the individuals spending huge amounts of money on AI, on chips. And I'm thinking more of the Alphabet CEO. I keep going back to that quote, who said a number of months ago that the biggest risk here was underinvesting, not overinvesting. That's where they're at. At some point, if you don't demonstrate the return on that investment, investors start to push back. That's the risk for this stock. And that's what we saw in recent earnings, whether it was from Google or Microsoft. Basically, if you could show profitability, you'd be rewarded. If you can't, you'd be punished. There's also there's a lot of existential questions around AI in terms of exactly what it's going to be used for,
predictive models? Is it going to be mostly cloud computing? Is it going to be mostly for the banking industry? And then how much do you need to see it expand outside of hyperscalers for people to really have faith in that long-term trajectory?
NVIDIA reporting after the close a little bit later. Let's talk about Game of Thrones again. President-elect Donald Trump picking Cantor Fitzgerald CEO Howard Lutnick to lead the Commerce Department. The search for Treasury Secretary still very much underway. Sources telling Anne-Marie that Trump will interview former Fed Governor Kevin Walsh and Apollo's Mark Rowan a little bit later.
So they found a home for Howard Lutnick in Commerce, and this was where a lot of tension was because he really wanted Treasury. Well, he was told no to Treasury, got Commerce, so now the fight really is between these three men, I would say, Scott Bessent, Kevin Walsh, and Mark Rowan. Two of them are going to have their interviews today in Florida, so potentially in the next 24, 48 hours, we will actually know. Just speculation. If you were playing chess, if you are Kevin Walsh, and everyone talks about actually long-term gain for this individual, former Fed governor, he has been consulting with the transition on economic issues. You want to be Fed governor. Well, Powell's term is up in 2026. Scott Bessent, I think, likely wants to be Treasury Secretary, given all this reporting we know. Maybe he does go to NEC, becomes the National Economic Director, the Larry Kudlow job. And then in 2026, there is a shift. That could be a 3D chess move. But at the end of the day, we still have two of these men that need to sit down with Donald Trump, and we just don't know yet.
Amid all of this personnel decisions, Ed Mills raised a good point. These are fiscal hawks. These people tend to try to reduce the deficit, which is the reason why the bond market's saying, okay, this is great. Problem is, does the stock market like it? Does that really gain the approval of the person in the Oval Office who wants to see, the stock market keep ripping, the Dow Jones, climbing to the moon? And ultimately, this is the tension. Will they be able to satisfy some of the agenda while satisfying the checks and balances that are bonds and stocks?
Every time I hear that phrase, I will laugh. Fiscal hawk. Extending the Tax Cut and Jobs Act will cost almost $5 trillion US. When we talk about being fiscally hawkish, we're talking about going out and buying a Lamborghini and then saving money on lunch. Mm-hmm. It's ridiculous.
Fair enough. But if you go buy the Lamborghini and you don't save money on lunch, then you're not saving that extra money. And also, there is this question. Kevin Walsh, when he was at the Fed, was a hawk. He didn't want to cut rates that quickly. He was more concerned about tamping down inflation. So what's that influence going to be at the Treasury Department?
And I was reminded last night that a lot of people over the past decade, their views have changed, especially more people moving into the hawkish camp when it comes to things like tariffs. You mentioned expanding TCJA. That's the base case.
Exactly.
What about everything else that President-elect Donald Trump promised? No tax on tip, no tax on Social Security benefits, expanding child tax credits, raising the SALT cap.
Yeah.
How does that also get priced in?
Just to echo what Lisa said, though, because I think this is important. When you go through these candidates, we stressed this yesterday, we're talking about really high-caliber individuals here. The likes of Kevin Walsh, Scott Bessent, Mark Rowan of Apollo. Tip-top, including Senator Hagerty as well. All of the above. But ideological differences, it's pretty big between Kevin Walsh, almost consistently, on monetary policy and trade, over everything I've seen come from Mr. Walsh over the last decade.
Pretty much everything that you've heard from people who are on Wall Street has not been consistent with high tariffs, huge walls, some of the other policy proposals that we're hearing from Donald Trump. So you just have to wonder, how much this is really going to cohere. And I will just say, a cup of noodles totally offsets Lamborghinis.
Absolutely.
Just go for it. Yeah, it's $1. You go, just pour in the hot water.
1 hour of payment or something like that. That's what you're going to save. Let's turn to the latest for Russia and Ukraine. Reuters reporting Russian President Vladimir Putin is willing to talk to US President-elect Donald Trump about a ceasefire deal in Ukraine. The deal could roughly freeze the war along current front lines. I'm pleased to say that joining us now is the retired Lieutenant General Robert Walsh of Academy Securities. Lieutenant General, welcome to the programme, sir. We appreciate your time. I'd like you to lean on your experience, your knowledge, and give us your perspective on how dangerous this new phase of the war actually is.
Yeah, good morning, John, Lisa, and Anne-Marie. It's very nice to be with you this morning. I think what you just talked about there, with Putin is willing to negotiate or talk to Donald Trump. Talking to Donald Trump is the Trump administration group has kind of come in and said that they're looking to have a ceasefire. And that ceasefire, I think, will be something that both Putin now is acknowledging, and I think President Zelensky is acknowledging. And so I think that is a key step that as we see things like just recently this week, the ATACMS introduced where the Biden administration is now allowing the Zelensky and his military to be able to use the ATACMS inside of Russia is an escalation, just as we saw the escalation of the North Korean troops. So I think anytime we can get the two forces together talking, as we are in this case, this is an advantage to both sides to try to bring this conflict to an end.
How concerning is it for you that we've seen this change of language yesterday from Russia as it updated its nuclear doctrine?
It's concerning in the sense that there was an escalation, obviously, by the Trump administration to allow the use of ATACMS inside of Russia. But we've seen the Putin administration use the threat of nuclear weapons consistently, whether it was F-16s, tanks, Patriot missiles. He considers that crossing the his red line and bringing NATO in, that if the U.S. uses ATACMS, it's bringing NATO into the fight. So we've seen this before. I think it's posturing. It's in a lot of ways, it's the same bluffing message that they've used before. So I don't consider this a serious threat, but it is something that can be used as we move closer to any negotiations that he can try to use as leverage that he has.
Well, how difficult is it to parse between what is a true escalation that should be concerning and what actually is just rhetoric for the use of leverage down the road?
Yeah, well, obviously, his threatening to use nuclear weapons has been posturing. He's used that multiple times throughout the conflict. However, the use of ATACMS, along with his use of introducing North Korean troops, were both escalations, clear escalations, by bringing for the first time troops from Asia, North Korea, into the fight. And besides just using, say, Russian troops or Chechen troops, he's now introduced another government's troops into it. That's an escalation. And I think that's when Secretary Blinken and President Biden said that crossed the line for us. And now we would escalate by allowing the Ukrainian military to use ATACMS inside of Russia. Both were escalations. And again, a lot of times these escalations occur in order to de-escalate the situation.
Lieutenant General, what are you looking for to understand whether this truly is an escalation in its own right and whether some of the threats are actually true versus an effort to get some sort of resolution?
I think all that now is with the Trump administration coming in with the standpoint of we're going to end this. And I think Trump's discussions with President Zelensky and President Putin over this, he's coming in with a very strong hand that he's going to end this. Both sides, I think, realize this. And I think now they're seeing the opportunity to come to negotiating table. So what we see happening now in the next few months is both sides trying to posture, the Ukrainian military and the Russian military, trying to posture to get the best position possible that they can have to get to that negotiation table. Obviously, the Ukrainian military, when they attacked inside of Russia for the first time into the Kursk region and grabbed some of that Russian territory, that was a positioning to get them closer to having leverage at the negotiating tables. Obviously, this has been a stalemate basically along the front with small movements either way, with Russian movements probably gaining more advantage of late. But again, this is driving towards the negotiations and who can have the most leverage as they get to that negotiating table.
This is fantastic framing, sir, and we appreciate your time. We're looking forward to having this conversation with you again sometime soon. That was the retired Lieutenant General Robert Walsh of Academy Securities. I want to draw your attention to the price of Target right now in early trading. Target is getting absolutely hammered. We're down in the pre-market by almost 20%. With an update on that and more, here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. So the details of those earnings, it cut its full-year outlook and posted flat sales for the quarter, Target that is. They said that the U.S. consumer spent less on discretionary items. Profit was also hit from a buildup in inventory. Target stockpiled more products in anticipation of what was ultimately a short-lived U.S. port strike. Now, those results, they do stand in contrast to yesterday's strong showing from Walmart. People familiar say that Comcast plans to spin off some of its cable TV channels. That includes MSNBC, CNBC, and USA. The NBC broadcast network, Bravo, and the Peacock streaming TV business, all those will remain with the parent company. Now, according to the Wall Street Journal, the separated networks will produce about $7 billion in annual revenue. Comcast shares up nearly 3% in the early trade. Emergency crews have extinguished a fast-growing brush fire in Upper Manhattan that burned over a dozen acres in the city. The fire broke out Tuesday afternoon in the Washington Heights neighborhood and was brought under control 3 hours later with no reported injuries. The blaze left the closure of several lanes of the Harlem River Drive. It's one of over 300 brush fires reported in the city since early October amid historically dry conditions. That's your brief. John.
Danny, thank you. And you can smell it across the city over the last few days, that's for sure. Let's draw your attention back to that move on Target. Target getting hammered in the pre-market. We're down by almost 20% off the back of some pretty weak earnings from them, cutting their outlook, having problems with inventory and with demand as well. This reminds me of May 2022, coming out of the pandemic, and having the same difficulties with inventory, but for different reasons.
So this is the problem for Target, is they've had some issues again and again, and people have been waiting for Target to really turn the corner on all of that. And the chair and CEO, Brian Cornell, said again, we encountered some unique challenges and cost pressures that impacted our bottom line performance, but what the shares are showing is you do it too many times, whether it's unique or not, whether it's dock worker strikes, whether it's some of the other issues that they faced, people are losing faith.
1/5 of the market cap gone. Just like that. Up next on the program, Starship blasts off.
5, 4, 3, 2, 1.
That conversation just around the corner, live from New York City. This is Bloomberg. Early mover for you, Target hammered. We're down by 19% in early trading. They missed, they cut their outlook, they got problems with inventory. It does not look good at all. The broader market's still doing okay. On the S&P 500, we're up by about 0.1%. If Nvidia reports numbers like this a little bit later, I don't think this is where the stock market's going to be. Nvidia reports after the closing bout, the stock market is doing okay. Under surveillance this morning, Starship blasts off. So here's the latest this morning. SpaceX achieving a successful launch of its Starship rocket in a much-anticipated event attended by Elon Musk and President-elect Donald Trump. Chad Anderson of Space Capital seeing big things ahead for space exploration, writing, under the new administration, expect an even greater focus on promoting the space economy and on commercial space integration into government programs. Chad, who has pioneered investment in the space economy for more than a decade, joins us now for more. Chad, good morning.
Good morning.
We've talked about the halo effect over Tesla, given the relationship with Elon Musk, with Donald Trump. What's that halo effect for a company like SpaceX? How important is it?
Yeah, well, I mean, I think it's a potent combination of having that kind of access and influence to the president, to the incoming president, and also to have the paramount solution in space. SpaceX is the apex player. So if they have a capability that the government needs, SpaceX is most likely to solve that.
You're invested in the company. Government contracts now, what proportion are they of overall revenue? What does that look like at the moment? How much bigger could that possibly be?
Well, government contracts play a big role in all companies across the space economy, and this is actually one of the reasons why it's been so resilient over the last couple of years when the equity markets have really struggled, because revenue's been hard to come by. But government contracts have increased. Conflicts around the world, geopolitical considerations, this race with China is all pushing a lot of dollars to capabilities. Space technologies are essential for our economic growth and national security. So governments around the world, including the U.S., are leaning in hard on these capabilities.
When it comes to a company like Tesla, you wonder about the halo effect, as John was talking about, for other car manufacturers as well. You talk about SpaceX and what kind of regulatory advantages could benefit other companies in the space as well. Are there any real competitors right now to SpaceX?
So you don't want to be in SpaceX's way, right? If you're building, there's a lot of benefits to SpaceX is building the railway, and there's a lot of benefit that now new opportunities become available that weren't available before. But you don't really want to be building something that's on their roadmap. They are the apex player, like I mentioned. We are finally starting to see some competition come online, I think, in 2025. It's going to be a big year. So this is the year that Jeff Bezos' Blue Origin is supposed to launch and reach orbit. Other launch vehicles are coming online that are using those Blue Origin built engines. Rocket Lab, a publicly traded company on the NASDAQ, is bringing out their new vehicle to compete with Falcon 9. But as these companies come online and start to compete with SpaceX's Falcon 9, SpaceX is already, superseding them and leapfrogging them with this new vehicle, Starship, that's coming online and really moving the goalposts.
Other than battle of the billionaires in space, what's the ultimate goal here? Is it to get to Mars? Is it to have tourism and on the moon? I mean, what is really the purpose? I
think it depends on who you ask. So if you ask us, we're really interested in the essential services that are coming from satellites. So this is not a luxury item. Most people think about the commercial, the International Space Station, the Apollo moon landings, space tourism. We're really investing in GPS positioning, which runs our financial markets. The modern global economy runs on GPS. Geospatial intelligence, so information about the movement of goods and what's going on the surface of our planet. Satellite communications. These are essential services. I think if you talk to Elon or if you talk to the president-elect, they'll tell you that Mars is the most important. And I do think that we're going to have a shift in priorities from the moon of the last administration and actually his prior administration to focus to go more direct to Mars and leveraging more SpaceX, Starship sort of infrastructure.
Chad, when it comes to Elon Musk and President-elect's relationship, they've been almost joined to the hip since the election. Elon Musk coined himself the first buddy. As an investor of this company, does that outweigh any concerns you have that maybe Elon Musk should be paying more attention to his businesses than hanging out at Mar-a-Lago?
Well, so you want, as Americans, we would want somebody who is knowledgeable to be in post, right? I think you think back to the social media congressional hearings, the AI congressional hearings, and you think about the questions that Congress were asking big tech, right? And you could see how out of touch they were, right? So you'd want people who are in that role to be knowledgeable. The challenge here and the interesting thing here is that the titan of industry is not retired and advising government. He's actively involved in multiple businesses that are going to benefit. So this administration has shown that they are very comfortable with conflicts of interest. I think we're going to see that play out. And so as someone, with a vested interest in these companies' success, very selfishly, I think that that's going to be very good for the company.
But you think it goes beyond SpaceX and Tesla? This actually is broader for the space exploration and that industry writ large.
Yeah, I mean, the space economy at whole is going to benefit from this. So SpaceX is likely to be the largest beneficiary for sure, given his proximity, but others are going to benefit. A lot of new novel capabilities are coming online. Regulation is having a hard time keeping up with all of this innovation. The president of SpaceX, Gwynne Shotwell, has said that it's regulation that's holding them back. Right, their test program will be happening at a much more faster pace, and so we think that we're going to see some of that pull through.
Chad, just quickly, they're going public anytime soon?
Well, I think a lot of people would like them to. I think there's a lot of benefits to being a private company. Sorry, Gwynne Shotwell has said that Starship is going to add a zero to their valuation. So already, like the most valuable private company, we're going to add a zero to that, I guess.
Wow, not struggling for capital, that's for sure. It's good to see you, sir. Appreciate it. Chad Anderson there of Space Capital. Coming up next on the program, we'll catch up with Steve Auth of Federated. We'll speak to the former World Bank president, David Malpass. Target getting hammered in the pre-market. We'll catch up with Chuck Grom of Gordon Haskett. And we'll speak to the China Beige book a little bit later in the next hour.
The name of the game right now is really quality at a reasonable price.
With some of the really good earnings momentum story, we're starting high and we're not really working estimates down as far as we normally do.
We're still digesting what the possibilities of outcomes could be for the Trump administration.
Many of the concerns we have going into 25 are, will inflation be too sticky? Will it reaccelerate?
For now, it's a better growth outlook for 2025, better confidence.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance starts right now. So here's a snapshot of the equity market price action. Equities on the S&P still doing okay, up 0.1% on the NASDAQ. The main point of focus on Nvidia earnings after the closing bell. But right now, Right now, there's only one single name to talk about. Target getting absolutely hammered in the pre-market. That stock is lower by 17.5%. Yes, 17.5. And the numbers from them 30 minutes ago, not great at all.
Yeah, we were talking about how Walmart was a beat and a raise. This was a cut and a miss. And basically what you're seeing is comp sales, expected fiscal year earnings, all of that worse than expected because of inventories, the buildup that they weren't able to sell. There's some larger questions here. Number one, is Walmart eating their lunch? Does that mean that they're eating the lunch of the others like Dollar Tree and Kohl's? And number two, is this a question of them not being able to meet a moment that is uniquely difficult that does read through to other retailers in a significant way?
You were talking about this yesterday, product mix and the demand for it clearly showing up. Some pain there over at Target, but the inventory point ahead of possible port closures, it's going to be really, really difficult to manage inventory for these retailers over the next several months. There's another deadline in the middle of January, and then Donald Trump takes office, President-elect Donald Trump, and we're going to see some big moves on tariffs too.
January 15th, that's going to be the day where basically the union has suspended these strikes until that date. Are these companies, these retailers, going to have to rethink maybe some of them that didn't go as far as Target in terms of their inventory buildup ahead of January 15th? Do they need to? Because it's going to come at a time where we're in the middle of also a transition of power. And then you layer that on top with the idea of tariffs. And we have a new man at the helm when it comes to tariffs. And that's going to be Howard Lutnick in this Commerce Plus agenda, tariffs and trade policy.
This time 2 weeks ago, when we woke up to that election win, and the prospect of a red wave down in Washington, D.C., the focus of this market was on a positive growth shock driven by deregulation and tax cuts. The focus of the appointments so far, the big battle over who's going to be the Treasury Secretary, it's not about that. It's about tariffs.
Yeah, and this to me ultimately will matter most to people like these retailers. I just want to say something, though. If you're trying to think about tariffs and how to get ahead of it and to pre-order, which you are seeing some signs of in terms of the export data from China, what do you buy when you've got styles that are moving so quickly? Down in the pandemic, remember, people were wearing yoga pants and sweatpants and sweatshirts, and then all of a sudden they had to go back to work, and and then you go back to work and you have to buy dress pants and you can't find them because they're not stockpiled. How do you assess the rapidly shifting fashions in this world?
I think it's really sweet that you still think people don't wear Lululemon pants to work, because let me tell you,
stop trolling me.
Many people have not given that up. Many people.
That's true.
Okay,
that's true. We have
so
seen a change of what is acceptable, I would say, in office attire post-pandemic.
Bramo comes into the office every morning wearing Lulu.
And then I put on my suit. Come on. You really going to troll me all morning?
Coming up this hour, Stephen Auth of Federated Hermes, as investors anticipate Nvidia earnings after the closing bell. We'll catch up with the former World Bank President David Malpass on Trump's Treasury pick. We'll speak to Chuck Grom of Gordon Haskett, reacting to Target earnings with that stock down and down hard in early trading. We begin this hour with stocks more broadly higher. Equity futures up by about 0.1%, lifted by tech optimism as investors look ahead to Nvidia earnings after the closing bell. Steve Auth of Federated Hermes seeing more room for stocks to run under a second Trump term, writing the following: the coming Trump presidency is likely to be positive for economic growth and eventually for lower inflation and interest rates. All of this is stock market positive, particularly for large cap values, cyclicals, dividend payers and small caps. Basically everything, Steve. He joins us now. Steve, welcome to the programme, sir. I was reading through your outlook. If you're not a fan of chess, move on to the next election outlook, clogging up your desktop or your mobile phone, your smartphone inbox. I carried on reading. You said we're playing chess and not checkers. What do you mean by that, Steve?
Well, yeah, checkers is more of a short-term game. You're kind of playing one move at a time. In chess, you're playing 2 or 3 moves forward. And I think a lot of folks think Trump is playing checkers. I think some of them think he's not capable of playing chess. And if you just take the other side of that debate and argue that he's playing 2 or 3 moves down the board and think through what those moves might be, you can go down the whole list of his policies and come away thinking, gee, this is actually going to be pretty positive. So if you're a longer-term investor like we are, we think the S&P probably gets to 7,500 by the end of 26. So, we think we've got a pretty good agenda here. And you can go chop your way down the list and see a positive outcome.
Well, Steve, let's go through the list. Tax cuts. You indicate focus on the growth and not the deficit. Tariffs, you suggest focus on the growth and not the inflation. Steve, can we sit on tariffs? Why do you think there could be a positive growth impulse off the back of that story?
Well, he is clearly here playing a chess game. I mean, he's pretty much said that, and he's negotiating, and I think people get that. So, the folks that argue that tariffs are just absolutely negative and inflation causing, they're playing checkers. They're just multiplying the amount of the tariff times the volume of goods being imported, and they feel that just carries through to inflation in effect. Trump is playing more the game that let's negotiate this deal and equalize the playing field. And the outcomes of all those things, if they work, we'll see, should be to bring more manufacturing back into the U.S., which is growth stimulative. It should bring in more volume into the U.S. He's going to get on the other side on deregulation, which is part of the picture. He's going to get more LNG exports. He's going to bring down the price of oil. That'll offset some of the price increases you will get with tariffs, but you won't get them all. The Chinese manufacturers, like they did the last time, will absorb probably a good hunk of the tariff increase out of their profit margins rather than raise price. They don't want to lose their competitive position. So it's not as simple as just multiplying the tariff times the volume. It's something a little more complicated. And my guess is he'll end up with more investment in the U.S. economy. We're already starting to see people move the piece on the board for that purpose. You're already seeing companies ahead of Trump starting to do that. So, I think net, it's probably growth positive, not growth negative.
So in this chess game, you lose your bishop, but it perfectly positions your rook. And if you lose your queen, it perfectly positions your horse to basically boost growth, not the deficit, boost growth, not inflation, and essentially create a lot more opportunities that get the equity mark of the S&P 500 to 7,000 by the end of next year and 7,500 by the end of the following year. I'm just wondering, at what point the one niggling feature on the other side of the board is the bond market that could potentially curtail some of this enthusiasm.
Yeah, I'm thinking about another piece, Lisa, like the double put. And one thing that long-term equity investors have going for them here is there are some boundaries on both sides of, potential tails here. So if, for instance, the Republicans go so crazy that the deficits look like they're going to go through the roof, you have a Liz Truss moment probably in the bond market. You guys have been talking about this. And so I think to a certain extent, the bond market kind of disciplines how far they can push some of their agenda. And on the other hand, the Fed's on the other side. If things slow down too much, the Fed just eases more. They've got lots of room to do that. So the stock market has these two, guardrails in effect that I think on a long-term basis make it pretty attractive for investors. It doesn't mean there's not going to be volatility. And, we keep a little cash on the side. We're a little overweight cash today, very modestly, but we always keep a little cash on the side in this kind of environment for opportunities. I mean, Target getting crushed 20% today. Not huge fan of Target, but we like it in some of our dividend portfolios. We'll be adding to it here. I mean, it's a little bit overdone. So you're going to get volatility like this for different reasons over the next couple of years, and those will be opportunities. But we think, we're going to end up in a pretty good place, I guess.
You can shrug off if you're the broader market, Target as basically a one-off for losing to maybe Walmart or maybe just overdone. If NVIDIA were to report earnings like this, as John was mentioning, it would be a huge problem. That we'd see a much different response, especially given how much the markets have really coalesced around the AI theme. How much do you think that can keep performing, that has to keep performing in order to keep this chessboard as advantageous as you see it?
Well, they don't have to keep performing. They have to just not get completely destroyed. I mean, NVIDIA's got a very good story, right? They're a monopolist selling to very well-funded customers who have an existential risk if they don't buy NVIDIA's products. For longer-term investors, the debate on NVIDIA is, are they selling razors or razor blades? And, you got to believe they're selling razor blades. That's sort of the bull argument on NVIDIA and why you would pay 30 times, 3 years out earnings for what's going to be continued double-digit growth because of what they're doing. Everyone knows the story. I think it's pretty positive. But NVIDIA could drop 20%. We've seen it before, and the market advance. Remember, 65% of the market is outside the Mag 7. And if you do get a broadening out trade, which we see as highly likely in this Trump pro-growth agenda that we're about to implement in a pretty aggressive way, that's a broadening out agenda. It's good for some of these value stocks, the financials. It's good for smaller cap companies. I think that case has been pretty well made. And so, if you get 65% of the market go up 20% and 35% of the market kind of hold water because it's got pretty good fundamentals, you can get the market higher, Lisa. I mean, 7,500 sounds like a big number, but it's roughly low double-digit returns. It's not crazy over the next couple of years. So you can get plus 10% in the stock market out of that kind of dynamic.
Stephen, picking up on the Trump agenda, I know you don't think that tariffs are going to be as harmful as some economists have projected, but if we go back to the first iteration of the Trump administration and they used tariffs, basically the impact was, in response from China, is that they were no longer going to buy some American agricultural products. And then we had billions of dollars in a bailout for farmers. What do you see for Trump 2.0 in terms of that reciprocity from some of these adversaries who might be putting up the walls for?
Well, LNG. The U.S. has a huge amount of natural gas. It's actually one of the more eco-friendly carbon products. And we've been holding back our LNG and our gas production under the current administration. So that's going to be one of the areas that he's going to trade here. He's going to have the Germans stop buying their LNG from Russia and buy it from the U.S. That'll be part of the trade, I guess. And perhaps even China, who import a lot of oil right now from Russia and from Iran. So there's things he can get done here that would be a natural quid pro quo, if you will, or trade-off that could be pretty positive for the U.S. economy. We employ a lot of workers in the gas, in the oil space. So,
Steve, just before you run, year-end 2025, the S&P, what's the target?
We're at 6,600 to 7,000, Jonathan. I like to focus on the 2-year thing where I got 7,500. I don't know how we got this year. This year we got a lot closer to our 2-year target in 1 year. So who knows? But, somewhere up there in the high 6,000s.
We've moved quickly. Steve, appreciate your time, sir. We'll catch up again before the holidays. Stephen Auth there of Federated Hermes with an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. The U.S. will provide Ukraine with landmines to stop Russian troop advances. It's the latest effort by the Biden administration to support Ukraine ahead of President-elect Trump's inauguration. The mines will be non-persistent, meaning that they will be inactive after a preset amount of time. California voters have rejected a ballot measure to raise the state's minimum wage to $18 an hour by 2026. It would have been the highest in the country. Supporters said that it would have benefited 2 million workers, like hotel and grocery employees. Opponents of it, though, including the California Chamber of Commerce, said that it would have increased costs, leading to higher taxes and push businesses to eliminate jobs. Netflix's Jake Paul versus Mike Tyson boxing match attracted more than 108 million live global viewers. That makes it the most streamed sporting event ever. The match peaked at 65 million concurrent streams. The news pushed Netflix's stock to an all-time high to a closing price yesterday. And that's your brief, John.
That is a game changer for sports worldwide, that's for sure. Danny, thank you. Up next on the program, all aboard the Trump train.
I do think that it's going to be difficult for anyone to get in front of the Trump train with respect to tariffs. You're not going to find many people out there that are willing to put the sort of tariffs in place that President Trump ran on during the election.
He might have found one. That conversation's up next from New York. This is Bloomberg. We've got to keep bringing your attention to what's happening with Target. It is down in the pre-market by about 18%, cutting its outlook, missing guesstimates, pretty dreadful stuff really, and having problems with inventory. The broader market's still doing okay. Equity futures on the S&P up by 0.2%. Under surveillance this morning, all aboard the Trump train.
I do think that it's going to be difficult for anyone to get in front of the Trump train with respect to tariffs. You're not going to find many people out there that are willing to put the sort of tariffs in place that President Trump ran on during the election. We're in a situation now where Trump inherits an economy where nominal growth is generally slowing down. So if tariffs are put on imported goods, I'm not sure which goods those would be, the prices for those goods would rise, but the prices for other goods would be coming down.
So here's the latest this morning. President-elect Donald Trump naming Cantor Fitzgerald's Howard Lutnick as his pick for Commerce Secretary, giving him an expanded purview over trade, tariffs and policy. Sources telling Bloomberg that Trump is in Florida today interviewing potential Treasury Secretary picks Kevin Walsh and Mark Rowan. Joining us around the table is David Malpass, the former president of the World Bank. David, good morning to you, sir. First question, got to address it. Have you been down to Mar-a-Lago to interview?
I was down there last week and met with people. Trump has the opportunity to put in really good people across the government, and I think that's the process. And it's happening quickly, much faster than in 2016. So I think that's great.
Were you down there for anything specific? You were part of the Trump administration. The first iteration started at Treasury, ended at the World Bank. What potentially could you see your role in Trump 2.0?
That I want to be helpful and doing that as I can. As I say, there's huge problems that need to be solved. If you think about where the U.S. has been left here at the end of the Biden administration, it's weak on foreign policy. It's got the economy still suffering from the inflation, the persistent inflation. The bank regulatory policy is really mixed up. Energy is not doing what it could be. So there's all these problems to fix, and I think there needs to be lots of people to do it.
So you're in the mix when it comes to the direction of policy. Can you talk to us about how do you see the direction of policy in Trump 2.0 when it comes to things like tariffs, given the fact that if personnel is policy, he put what we've envisioned over the course of the campaign, a tariff hawk in charge of commerce. That individual did not get the nod for Treasury that he wanted, Howard Lutnick. But with this commerce appointment, the statement said he'll have more of a role in USTR as well.
We have to look to how the president phrases it and what he wants done as far as who's pushing forward the agendas. This idea of commerce and USTR being attached is a long-standing one. I worked for Senator Auth in 1990 when there were the actual proposals to merge them because of their overlapping roles on tariffs. And so that's not new. But there's so much to the whole agenda. Think of what has to be built out in terms of downsizing the overreach of Washington. All these people that are employed to write regulations that slow the economy. There are better ways to do that, and that's one of the major initiatives. Another one is on energy. Think of the strength of the team that's been put in place with Chris Wright, with Burnham, Governor Burnham, and with even Lee Zeldin. EPA is going to be an important part of it. And so you've got the core of the team that can really create energy growth for the U.S., and that's good for everybody in terms of affordability.
Okay, maybe the core, but the nucleus of this team we are missing is a Treasury Secretary. And right now there's 4 names. Maybe we would even say it's coalescing around 3. Scott Bessent, Kevin Walsh, Mark Rowan. 2 of them will be in Palm Beach today for interviews. Do you have an idea of what the president is looking for when it comes to his Treasury Secretary?
No, I don't have insight on that. He wants really good people that are going to get the job done and get it done fast, and that's pretty reasonable.
And what do you think of these 3 individuals we're showing right now?
They're good people that can get the job done, get it done fast. You know, the tax bill is going to be needed right off the bat. So as you look into 2025, I did that Wall Street Journal article on the fiscal train wreck, or it's really a perfect storm coming together. You've got to get the tax bill done. You've got to get a budget out really fast. You've got the debt limit coming at you, and it's a very difficult one because you've got to get your party to vote for increase in the national debt. That's always a sticky one, has been for 30 years. The reconciliation bills will be challenging, and all of that has to come together with the clock ticking in terms of market confidence. You want to build the confidence in markets as you go forward.
So this is the reason why a lot of people are saying that in the first administration for Donald Trump, the stock market was the ultimate check. In this administration, it's going to be the bond market. How do you create both the growth that the stock market is expecting and the fiscal discipline, or at least lack of complete irresponsibility that the bond market is looking for with that kind of sequencing deadline and the different internecine politics in D.C.?
I think it can be done, but that goes to this core of the models. You know, if you use a Keynesian model, you say, well, if you shrink the fiscal deficit, it will slow the growth rate of the economy. You've got to really break out of that and say, no, if we're shrinking the size of government spending, that frees up the money for the private sector. So you get faster growth. And so it's almost the opposite of a Keynesian model. And it's the same with the Phillips curve. You know, the Fed is so dependent on this idea of the offset between employment and inflation, but it doesn't work that way. If you've got confidence in the dollar as the reserve currency, you can get low inflation and that price stability. That's your dual mandate, and then you get full employment out of that. So the various tools or levers work together, not against each other.
What's fascinating to me is to hear your perspective on this at a time when you used to be the president of the World Bank, and so you had a very clear sense of the international perspective. And back in APEC and in the G20 in South America, there was this feeling of, who cares what's going to happen here because it doesn't really matter. Everything's going to change. Do you get the sense that this president is going to care about kind of where the U.S. lands in the geopolitical landscape here?
I hope so. The U.S. has gone way too far into globalism, and you saw that on display over this last week. Where you were in South America. You see these giant conferences going on where there's no useful outcome, and where the U.S. is embarrassed by its position within the world. China is dominating in those international conferences. So I think there has to be a real rethinking by the new administration of how do you want to interact with the world. That applies to trade. That applies to how do you work with the IMF when the programs aren't working. You know, look at the Argentina debacle and on down the list. And that means the U.S. looking for its national interests more clearly than what we've been doing. There's almost been this view and action to say we want to give power to institutions that are headquartered in Europe because they're going to be socialist. And that, I think, really has to stop.
Do you think it can change?
Yes, certainly it can. The U.S. is, you know, the dominant world economy. People forget that. 25% of world GDP, totally powerful. It's just been absent, you know, so there's the vacuum in the world. Look at it in Africa with the weapons flowing down from the north. Russia's putting weapons not only into North Africa, but into Gaza, into everywhere you can look, into Syria. And China then is building the infrastructure and the pipelines and putting on the debt. So it's dominating. And the U.S., you know, France is long gone and the U.S. is getting pushed aside. That's the base closings in Niger, the loss of Sudan, and the Houthis not being able to be controlled. So the weakness of the U.S. is on full display to the world. That was particularly apparent in Lima with the conference there.
David, we've got to go. It's
okay,
good to see you.
Nice
So thank you. David Malpass, the former World Bank president, with some very important points at the end there. Up next on the program, Target getting absolutely hammered. Two big earnings stories. Target out a little bit earlier. Later on today, you'll hear from NVIDIA after the closing bell. We'll get to Target in just a second. Equity futures right now on the S&P 500 up by 0.2%. With your morning movers, here's Manus Cranny. Good morning, Manus.
Jonathan, a very good morning. 24 hours ago, we were talking about Walmart, broad-based strength. Today, I give you Target, wiping out this year's gain and some. We're down almost 18%. Flat sales, a lackluster guidance. We are resourceful and strategic in the purchases that we're making at Target. This is, of course, we're judicious when we go into Walmart, but they are sucking up the middle class, those people, those hardworking people that go into Walmart as well. The breadth of what Walmart are taking in is taking market share. That's the basic understanding that's going on in Target. Full year, $8.30 to $8.90. That's way below the original estimate guide of $9 to $9.70 from the market. Let's roll it over. Yeah, there's a little bit better footfall and digital is improving. Comcast. Remember 2011? They got their hands on NBC. The crown jewels were the cable assets. MSNBC, CNBC, USA. Now, They're hiving those off. They spin off. They floated this idea in October. Today, we understand they will confirm it. They will spin off the cable assets, $7 billion in annual revenue there. And what will stay in the family is Peacock, broadcast TV, sports, movies, and theme parks. And housewives. Real housewives. That stays in the family. That makes a few dollars. MicroStrategy, inextricably linked to what happens in Bitcoin. Bitcoin's at the bottom of your screen, breaking through $93,000. But again, it's what is Michael Saylor doing at MicroStrategy? Not only is he adding another 51,000 Bitcoins on Monday, but he's actually offering more convertible stock to embolden his capacity to buy more. This stock is now worth as much as Barrick Gold and Newmont Mining. $97 billion in actual market cap. That's what you call heft and outshining gold.
Manus Cranny, thank you, sir. Comcast, big story. CN, never heard of them. Is that the marketing unit of the Dow Jones? Is that what that is?
Wow, you're really going to go there. Honestly, all I could say is it's going to be an interesting time. I'm not going there. You're going to try to put this on me?
Respond. It's all right. I can go to NVIDIA now.
Thank you.
Under surveillance this morning. Investors are waiting NVIDIA earnings after the closing bell. Its forecast expected to show whether the world's most valuable company can continue to deliver on AI demand. Revenue expectations span roughly $8 billion, reflecting analysts' uncertainty over chip supply. That stock this morning is up by about 0.5. It's flying already so far this year. If you missed this a little bit earlier on the program, I'll repeat it again. It came from Gonzalo Assis over at Bank of America. NVIDIA earnings matter. It remains the most dominant stock on the market, driving 20% of S&P 500 return over the past year.
And the earnings have backed it up, and the beats and the expectations have backed it up even more so. Steve Auth was on earlier at Federated. I know you did the same calculation that I did. He said it could fall 20% and it would be just fine. That would be $720 billion erased from stock market valuations in the United States. And he's saying, well, everything else could take over. There is a bigger existential question that I think needs to be answered by NVIDIA. How is it being deployed? How internationally is it being deployed? Can they meet that deployment? And do you have the same kind of investment in the coffers of some of these big hyperscalers to continue, even if they're not necessarily quickly showing profitability?
Dan Ives says the recipe for success here and what the Wall Street wants to see is another $2 billion beat and $2 billion quarter guide higher. He says that's the recipe. Then you look at what HSBC puts out, and they say it's entering uncharted territory because it continues to grow on a $3.5 trillion market cap. This is ginormous. And whatever NVIDIA does this afternoon, I think will depend on what the stock market as a whole does tomorrow morning.
We've just seen this on repeat. Beat and raise, beat and raise, beat and raise off a bigger and bigger base, and they keep doing it time and time again. That stock is up by 0.5%. Elsewhere, the search for President-elect Donald Trump's Treasury Secretary continues. Sources telling us here at Bloomberg he's expected to hold interviews today with former Fed Governor Kevin Walsh and Mark Rowan of Apollo Global Management. On top of that reporting, Anne-Marie, what is the latest?
So that is the latest. We're going to get these interviews today. So potentially in the next 24, 48 hours, we could have the final pick for the Treasury Secretary. And then whoever's the Treasury Secretary, we're going to want to know who's going to be the NEC director. Last hour, I gave an idea of speculation of potentially you have Walsh at Treasury, then he goes to Fed in 2026, Bessent at NEC, then he goes to the Treasury in 2026. Or there's another 3D chess, potentially. This is all speculation, and people are also writing in, speculating what they think as well. Given the fact that Howard Lutnick is now out of the running, and he's been given a home at Commerce, does this potentially mean that Scott has a chance to rise to the top over these two individuals that are going to be meeting with the president today? We'll wait to see.
I love the excitement as we go through the blow by the latest in the show.
Sounds like the preview of the second episode in Succession or something like that.
Well, it kind of is. That's what we're looking at right now. I think there is this larger question for markets. What are the checks and balances going to be? And if you do get ultimately fiscally less dovish, I don't want to call it hawkish, since last time you did highlight the sort of irony of saying that, then what does that do to some of the market expectations for animal spirits, as well as, you know, the joy that you might see, the relief in the bond market?
We've said it on repeat on this program. The biggest regulator in Trump Term 1 was ultimately the Dow Jones. This time, it could be the bond market. We've heard that from Julian Emanuel of Evercore, Ed Mills of Raymond James, from Steve Auth of Federated in just the last 90 minutes alone. Everyone on the same page on that front.
I really think that this is going to be the year, next 12 months, make the yield curve great again. And I think we're going to see it again and again.
Possibly. Trump also appearing alongside Elon Musk at a SpaceX Starship launch in southern Texas. The president-elect's first time attending such an event. Allies including Senators Bill Hagerty and Ted Cruz joining the group at a viewing location about an hour before liftoff. This company very much in focus. We've spent tons of time, mainly because it's a public company, on Tesla and the halo effect that comes from that relationship between Elon Musk and Donald Trump. Not enough time talking about this.
About actually, this was successful, even though there wasn't this cupping effect that they wanted to see. This was a successful launch. We will see a number of launches. I know everyone's focused on the rockets, but for me, it was the second you texted me and you said, look, I think that's Senator Hagerty. He was there. And we've seen the president make decisions about personnel when he was with people on planes, which is why it was interesting to see him tag along to this rocket launch when he was supposed to be having an interview that morning with us. That's what happened in the next episode of Succession. Just hold on. But in the meantime, the idea of satellites and the idea of some of the architecture for the communication system and defense system that this actually brings, to me, is fascinating.
I've got a lot of time for the senator from Tennessee. It's a great guy. It's a fantastic guy. Let's turn to shares of Target plunging this morning. The company cutting its earnings outlook for the year as shoppers spend less on non-essential items. That stock is down 18% in early trading. Chuck Grom of Gordon Haskett joins us now for more. Chuck, this was a shocker. What went wrong over at Target?
Yeah, I mean, it is a shocker, but it's more below the top line that was a surprise. The top line comps up 0.3%. That was pretty much where the buy side and ourselves, we were modeling 0.5% of an increase. Came in, traffic was strong, digital volume was strong. It's really on the gross margin line for them, and it appears to be inventory related, supply chain related. In other words, it seems more company specific than industry related, and we'll find out over the next couple of days. We're going to get a lot of reports. We just got TJX that just hit. The numbers were actually very strong, more in line with what we heard from Walmart. But don't get me wrong. I mean, company guiding down 9%, stock indicated down 16, 17%. My gut, that looks like a little bit of an overreaction. Don't get me wrong. Stock needs to be down today. But we'll find out on the 8 o'clock call what's really going on here. And zooming out, like it's important to keep in mind that Target's had issues that are very company specific in the past. They tend to have issues with inventory management, supply chain. My initial reaction is it looks like something like that we've seen in the past from them.
Chuck, it took me back to May 2022. I'm sure you remember that well. The stock cratered on that earnings report as well. Chuck, what's the difference between the challenges they face now and the problems they had back then coming out of the pandemic?
Well, first of all, you have a great memory. Second of all, I think what's going on here with Target is, you think about Target, it's about expect more, pay less. I don't think they're focusing enough on the expect more side of the equation. And I think they're focused too much on price. It's hard to battle with Walmart and Amazon and Costco on price. They're known for their fun merchandise to differentiate in apparel and in home. And I don't think they're doing a really good job with that right now. And that's evidenced of a 0.3% increase in their comp relative to Walmart, who just printed a 5.3% yesterday.
So expect more is doing a lot of heavy lifting here. Are you talking about a product mix that they need to have higher end goods? Are they talking about what areas they're trying to target? Because that's what it sort of is screaming to me when you say maybe less on the price.
Yeah, I just think that they're known for their exciting product. And whether it be private brands or whether it be national brands, they've got great partnerships with Disney, with Ulta. On Black Friday, they're going to have a big Taylor Swift offering. I just don't think they're doing enough of that. And that's where, if you look at their comp, their general merchandise business has been soft. And that's the area that tends to be margin accretive for them.
At this point, Chuck, I just wonder how much we can extrapolate a larger story here of Walmart gaining share or pressuring all other retailers that are in the same kind of bucket due to their multifaceted business strategy, the fact that they have the offsets of advertising, of their media, of their marketplace, of their online unit that can allow them to win on price. And then it forces everybody else to scramble. Are we going to be seeing that in all the results from all the retailers?
I think that's going to be the case when you look at the results at the low end for Dollar General and Dollar Tree. I think in particular they're under a lot of stress from Walmart's second P&L, which is, to your point, is funding a ton of price investments. And if you think about it in a baseball game analogy, we're in the first inning of that. So that's not going to get easy. I think when you zoom out, a 1% comp move at Walmart is roughly $1.2 billion. A 1% comp move at Target is $200 million. A 1% comp move at Dollar General is $100 million. So it's just a comp number for Walmart, but the market share, when the pie is not growing, is just simply magnificent what they're doing right now. And we're buy rated on them. We like them. We've had a buy rating on Target. Obviously today hurts. It's a cheap stock. Again, I think the issues are more company specific than they are sector specific.
Chuck, when it comes to the sector, though, we have the dock workers union suspending that strike until January 15th. Then, of course, we have this lingering potential for tariffs. How are the retailers going to be preparing for those two events, considering the fact that Target potentially overshot here when it looked at their stockpiling, and given the fact that that port strike was relatively short?
Yeah, I mean, most of the companies we talked to back in October were thankful that it only lasted a couple of days. And I think the rule of thumb was every day of a strike was about a week of backlog and inventory. So we'll see what happens on that front. And with regards to tariffs, I mean, most of the companies are better prepared today than they were 6 or 7 years ago. That's not to say if it's a meaningful increase in tariff prices, how they're going to deal with that will be interesting. It just seems very inflationary to me. And if President Trump-elect wants to be mindful of that, then raising tariff prices across the board, there has to be an offset. So more to come, and we'll obviously learn more over the next week with a lot of earnings here in retail.
But do you see those retailers preparing now for things like tariffs down the road?
Well, I think the one area you will see companies prepare for potentially is accelerating inventory receipts in quicker and earlier. And so I think that's something that retailers will prepare for. And as a result, working capital will be deprived here in the fourth quarter because inventory balances will be higher at the end of the year.
We've asked a few guests about this. I'd love your recollection of what happened maybe 8 years ago, 7 years ago, when we had that first trade war between China and the United States led by Donald Trump. What changed for many of these retailers? Have they changed where they source, where they get product from? How much has changed?
Oh, lots changed. I mean, a lot of companies we cover, Floor & Decor just comes to mind who, 8 years ago, they were sourcing 50% of their inventory from China. Last year, it was 25%. This year, it's probably closer to 15%. So companies are moving everywhere they can. And I would anticipate that will accelerate next year.
Battle hardened. Chuck, appreciate it, sir. Thanks for joining us this morning. Chuck Grom there of Gordon Haskett. Weighing in on what's happening here with Target. So Target's down by close to 20%. Just to go back over what Chuck was talking about there, an industry problem or a single name problem? If you look at the industry, Walmart, beat and raise. TJX, just moments ago, beat and raise. Miss and cut over at Target. Just looking at that, and it's early days, you just take a step back, you just look at those three things, sounds more like a single name problem than an industry problem.
And he's saying expect more, pay less. They're talking about pay less a little bit too much and not the expect more, and that maybe it's the product mix that they need to focus on and offering more interesting brands and things of that nature. So watch what's in the space in the next, in succession, Target style.
Stock is down by 18% in pre-market. Not a good episode for them at all. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. A key gauge of Eurozone wages jumped 5.4%. That's the most since the euro was introduced in 1999. It comes as the ECB hopes to normalize rates and grapples with potential new tariffs coming from an incoming Trump administration. The ECB's Louis de Guindos spoke to Bloomberg on the threat.
Trade distortions, at the end of the day, can give rise to a sort of vicious circle. If they derive into a sort of trade war, that could be extremely detrimental to the world economy for both growth, mainly for growth, but as well for inflation and for asset valuations. And I think that this could give rise to an additional negative impact to the situation of growth.
Elsewhere, Japanese Prime Minister Shigeru Ishiba has reached a deal with a key opposition party on his economic stimulus package. The Prime Minister has vowed to include tax cut proposals among the measures. The stimulus package is set to provide more money to low-income households and reinstate subsidies for electricity and gas bills. Tesla chair Robin Denholm cashed in on Tesla's post-election surge. Regulatory filings showed that she exercised stock options that were set to expire next year and sold the shares on November 15th. She netted about $32.5 million from that stock sale. The EV maker has been one of the best performing stocks after President-elect Trump's victory. That's your brief, John.
Danny, thank you. More from Danny in about 30 minutes' time. Up next on the program, Trump's Secretary of Trade Tariffs.
At the turn of the century, Our economy was rocking. We had no income tax, and all we had was tariffs.
I think we can all go with the no income tax stuff. We're all on board. From New York, that conversation up next. This is Bloomberg. Equities on the S&P 500 look a little something like this. We're still positive by 0.2%. Yields bleeding just a little bit higher, up by 3 basis points. The 10-year, 442.57. Under surveillance this morning, Trump's Secretary of Trade Tariffs.
At the turn of the century, our economy was rocking. We had no income tax, and all we had was tariffs. We took down our protection. We took down our tariffs, and we turned instead and we taxed Americans. We're letting the rest of the world eat our lunch.
So here's the latest this morning. President-elect Donald Trump picking Howard Lutnick to head the Department of Commerce, leading the tariff and trade agenda for the incoming administration. Shehzad Qazi of the China Beige book writing, the president has nearly unrestrained authority when it comes to levying tariffs, and a Republican-dominated Congress will not be standing in his way. This means the Trump team can move very quickly on a package of big China tariffs. Shehzad joins us now for more. Good morning to you, sir.
Morning.
We've seen this movie a few times. We think one person's in charge, but ultimately it's Donald Trump. When I joke about the Secretary of Trade tariffs, does it just belong to Donald Trump? Is it all top down for you?
Yeah, absolutely. This is absolutely top down. It's what the president wants. And as we know, he will yell out to the staff, go get me tariffs, right? And then they work on putting together the executive orders that meet what the president wants. Will there be debate, discussion, fighting? Maybe a little bit of fighting this time around as well. But everyone will be ultimately, I think, have to bend to the will of the president rather than the other way around.
One thing we're grappling with in markets is drawing a distinction between campaign promises and legislative reality. How much daylight is there between a campaign promise and what you think the reality will look like in the coming year?
Well, look, at the outset, reality could mirror the promises, right? Because President Trump might want to make a big splash and come out and say, look, we're gonna go 50% tariffs on everything China, and yes, we're going to do 10% global tariffs. Now, does that actually what he runs with? Ultimately, when the orders are written and when we start getting policy on paper, that's up for debate, and that's, I think, what the markets are going to be having a very hard time marrying what he says when he gets in front of the cameras versus what actually ultimately gets done.
On this program, we talk a lot about personnel is policy, and right now it looks like Howard Lutnick is giving a lot of scope to run the trade and tariffs. Trump in 2016 really put that with Wilbur Ross. And then at the end of the day, it was actually Robert Lighthizer where all the power lied. How do you see this shaking out in Trump 2.0?
Look, I think we're going to see a lot of influence from not just Ambassador Lighthizer, but I think some of his proteges who are also most likely going to be part of the administration. Some of this work has already begun, and chances are a lot of this is going to kick into high gear between Thanksgiving and Christmas as they start putting together some of those draft orders that potentially the president could sign when he goes back to the Oval Office after inauguration.
When China is seeing all this play out in this transition, how are they preparing?
I think it's clear that they have decided to reserve some of their fiscal firepower for next year. That said, don't call it stimulus, because if you're having to spend more money just to cushion the blow from tariffs, essentially maybe running in place at best, that's just stability. That's not really going to propel the economy into higher gear. But I think they're certainly taking a step back. They want to see what the damage is going to look like before they tell you how they're going to take care of it.
Well, that's what everybody's been saying. And then they came out with something that was sort of a bazooka, and then people got disappointed and said, just wait, they'll come out with something more. What is their capacity to respond? And is it internal stimulus, or is it further tariffs on the U.S.?
Further tariffs, retaliatory tariffs, is part of the approach that they will take. They could even figure out a way to go after certain American companies to punish specific entities. But that said, the capacity is not the issue. It's what they want to do. They don't want to do big household stimulus. They don't want to have the housing market reflate again. They want to do risk mitigation. That's why you're seeing a lot of focus on paying down debt at the local government level or moving the debt to balance sheets, to the center's balance sheets and so forth. So it's stability, it's risk mitigation. It's not this big bazooka-style stimulus that the street keeps telling is going to happen and just doesn't happen.
There's also this question of the method that they've used to try to boost their economy, which is production. And some people might say overproduction of certain goods, and that it needs to be exported because they're having overcapacity for certainly their population. What does it do to the balance of exports if the U.S. effectively puts up walls of tariffs?
Well, first of all, there's a lot of rerouting of trade. So we have to keep that in mind, that this is not like 2016. A lot of trade has been, as a matter of fact, rerouted. So we could see the Chinese export machine still doing all right because it's coming out of, ultimately, the goods are coming in through other jurisdictions into the United States. The other side, by the way, of China saving its firepower for next year is that if they just keep making policy easier and providing a lot of money to their manufacturers, to their commodities producers, it could actually exacerbate the very problem that Trump and company want to address. You could still have Chinese goods flooding the market because back home, Beijing is taking care of its factories.
You used to have this word decoupling, and that became a really bad word, naughty word, particularly if you were Janet Yellen and the Treasury Secretary. Then this other word came in, de-risking, but you couldn't use that one either. You had to say diversifying. How have they diversified in the last 4 years? If you're a US company with a presence in the United States and China, how have they diversified?
So China plus one is being talked about all the time. That's another cliche. But my concern always is you can do China plus one maybe for lower end goods. But what do you do if you're Apple? What do you do if you're complex pharmaceutical products or medical equipment providers, where there are just no other countries where you can go today and produce those products? And so China plus one, I think, is limited.
Are you saying that's because of knowledge and not because of the price of labor? You think it's knowledge?
Price of labor, I don't think, is the main driver anymore. It is the infrastructure is already there, the knowledge is already there, the know-how is already there. It's going to take a long time to retrain workers elsewhere.
How well understood do you think that is when you speak to people?
I think corporate CEOs have probably tried to explain that to policymakers, which is why you're getting policymakers perhaps not talking about it as much. But it needs to be done, I think. That's my personal opinion, but it's going to be complicated.
This is really important stuff. You can't just flick the switch and move somewhere else.
Have you seen what goes into some of these manufacturing plants for solar panels? Talk about semiconductor chips in Taiwan. It is such a complicated process. People are trained for years to be able to do that. There's an entire training ecosystem around that that's very hard to replicate.
Which is what should have happened in this country a long, long time ago and ultimately did not. Shehzad, it's good to see you. Thank you, sir. Shehzad Qazi there of the China Beige book on the latest tariff effort, what the next year looks like and how China might respond. Up next on this programme, we'll catch up with Tracie McMillion of Wells Fargo. We'll speak to Pierre Ferragu of New Street Research as we await numbers from NVIDIA after the closing bell. Matt Luzzetti of Deutsche Bank, and we'll speak to Vishal Khanduja of Morgan Stanley on the latest in this bond market and why it might be the ultimate regulator of whatever policy comes out of the White House. We've heard that a few times so far this morning. Equity futures on the S&P up by 0.2%. Target down and down hard by 19%.
I think the hawkish tariff stuff is already in the price.
The market trades Trump as a yield curve steepener.
The reality is the market has looked past a lot of the geopolitical risk.
When we talk about exhaustion, we're talking about really high sentiment. You're pricing in all of this good news.
NVIDIA is the #1 high quality stock. So we want to continue to embrace quality.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The third hour of Bloomberg Surveillance starts right now as we count you down to the opening bell. 90 minutes away. Equity futures positive by 0.2% on the S&P. On the Nasdaq 100 up by 0.25% as we await numbers from NVIDIA. Numbers from Target dropping a little bit earlier. And that stock drops a whole lot. We're down by 18% on Target. We had a beat and a raise from Walmart, a beat and a raise from TJX, and a miss and a cut from Target this morning.
Fool me once, maybe people can move on. Fool me twice, and then it becomes a chronic problem. And that's essentially what's happened when you talk about idiosyncratic issues. The Target points to that cause the inventories to build and provide a bigger drag on earnings than they expected. There's some big questions here about how the behemoth of Walmart and some of the other large players are pressuring other companies in the retail space to understand what their business model is and target what works, no pun intended. The idea being that maybe competing on price is no longer the advantage as maybe on product mix.
But given the fact that the company's profit was hurt by the stockpiling because of the ports, is this a harbinger of potentially what other companies might be dealing with when that strike is going to come to a head January 15th? And then even longer down the road, if you start building up stockpiling, you start building up inventory, because why? You're nervous about tariffs. How difficult is that going to be to weigh the policy signals that are coming out of Washington?
Should we be nervous more broadly? Chuck Grom of Gordon Haskett was on the program 30 minutes ago, just after these numbers dropped, and he said this looks like an industry problem. No, it looks like a stock problem. And that's why you're seeing the broader market still doing okay. The enthusiasm and confidence going into 2025. Take a listen to this. We've got BMO at 6,700. Goldman Sachs at 65, Morgan Stanley at 6,500. We spoke to Julian Emanuel, who's looking for 6,600 in the middle of 2025. Steve Auth, the Federated, said we could push to 7K by the time we get to the end of next year. And a reason why: there's a big focus on tax cuts and deregulation, which is why this cabinet pick matters so much in the next few days. Look at this lineup. Check out the caliber of some of these individuals. Scott Bessent, Kevin Walsh, Mark Rowan, Senator Bill Hagerty. We're looking at individuals that could be the most knowledgeable of financial markets that we've seen since Hank Paulson, at a time when this economy is in a much better position.
Absolutely. When it comes to the plethora, the buffet of individuals Donald Trump has to choose from when it comes to the Treasury Secretary contenders, each one of these individuals are really experts in their field, in not just markets in the United States, but global financial markets. But they will have a big job ahead of them. One, dealing with Congress on the debt ceiling, day one. That's going to be first order of business. Then it's going to be shepherding Donald Trump's agenda when it comes to taxes. Is it beyond TCJA extension? And then third, pushing back potentially on what Howard Lutnick might want to do when it comes to trade policy at Commerce.
Take your politics out of all of this. Let's say you get Bessent at the NEC and you get Mark Rowan at Treasury. We're talking like Pippin Jordan type stuff, like dream team material to run the economic policy of the United States of America.
So if you get the Chicago Bulls lineup from the 1990s in the White House or in the cabinet, there's a real question here about whether President-elect Donald Trump will like that, because whether the policies will actually be equal to what he's trying to put out there in the rhetoric. And I think that's the uncertainty that you're feeling in markets as they look at these picks to understand, is the priority on tariff man, or is the priority on the idea of how to create the best mix of policies?
Game of Thrones continues down in Palm Beach, Florida. Coming up this hour, we'll catch up with Tracie McMillion of Wells Fargo as markets await NVIDIA results. We'll speak to Pierre Ferragu of New Street Research on the chip giant's AI infrastructure outlook. And we'll catch up with Matt Luzzetti of Deutsche Bank on why next month's Fed meeting is a close call between cutting and skipping. We begin this hour with stocks higher as investors await earnings from the world's most valuable company, NVIDIA. Tracie McMillion of Wells Fargo staying cautious, writing this: NVIDIA has market-moving potential. Given the sizable post-election stock jump, we want to be a bit cautious over the balance of 24 and into early 2025, but think broader risk opportunities are developing. Tracie joins us now for more. Tracie, welcome back. Where are those opportunities right now?
Yeah, John, good morning. So we think that the opportunities are mostly in U.S. large cap stocks. As you mentioned, NVIDIA will be reporting later today. And of course, they're a bellwether for AI spending. So we will see if the torrid pace of AI spending has held up. If they have another blowout quarter, we think that probably gives investors the green light to continue holding their Mag 7 stocks. So that will indicate status quo. If they fall short, then we could see that roil broader markets, we think.
Tracie, we shared a snapshot of your outlook into 2025. I think it's worth going back over the fact that we're on track for a 20% plus year on the S&P 500, the very few saw coming when we played out this exercise 12 months ago, looking out 12 months. How much harder is it this time around to provide a forecast, any kind of projection, with any confidence for the next 12 months?
Yeah, so it's actually a bit more difficult, as you mentioned. In fact, a red sweep was not our base case, so we are reformulating some of our forecasts as we speak, because we are expecting probably higher growth and higher earnings due to improving regulatory conditions and the potential for tax cuts. So that just have us rethinking our forecasts.
Tracie, which aspect of it in particular? And this is actually what we've been trying to gauge from a lot of people. And I get a lot of sense that maybe people haven't really determined what potentially could be affected by the policy change. Is it that yields could potentially be higher? Is it stock prices could potentially be higher? Are there certain sectors that you could see upgrading more significantly?
Yeah, so it's very possible that we could see higher yields, higher inflation, higher growth, all of those things combined. So there are certain sectors that we like. We've liked cyclicals into the election over the past few months. We have favored industrials, communication services, energy, financials. We think financials are particularly interesting right now because of the regulatory benefits, the benefits of yield curve, a steeper yield curve and net interest margins, and the potential for additional mergers and acquisitions, which could benefit investment banks.
So, Tracie, what do you have to see in order to really make these changes to your outlook? Is it a personnel issue? Is it just you're looking to understand what the market is doing and how it's responding already?
Yeah, there's certainly going to be a lot of things that will play out over the next couple of months and things that are going to play out into 2025 as well, because we don't know a lot of things like timing of potential tariffs, magnitude of potential tariffs. Geopolitical issues are another risk that we've got our eyes on. We also are watching consumers to see if consumer spending starts to pull back as consumers get more price conscious and perhaps more concerned about higher prices relative to tariffs. So a lot of factors go into those decisions. And right now we're still favoring U.S. over international. We like large caps over small caps. And we like those cyclical sectors over more defensive ones.
So you're very much into U.S. exceptionalism, and you're pricing in some of the good things potentially you could see from a red sweep. But what about this idea of tariffs? How much of a bite could that be on corporate America?
Yeah, tariffs are probably going to hit both consumers and corporations. So consumers in the form of higher prices, corporations in the form of lower margins. So it's probably going to be some combination of that. And this time around, we wouldn't be surprised if we didn't see corporations passing on more of those higher prices to consumers because they've seen that they have more pricing power than what they had back in 2018 during the first round.
And your probability is for a soft landing, but you say a recession, we're not out of the woods. What's your probability on potentially recession for 2025?
Yeah, so we think that that's a pretty low probability at this point. We do see some slowing in economic growth. In fact, we've seen some slowing through 2024 relative to 23. We think that slowing continues a bit here over the next couple of quarters, but then we see the potential for a reacceleration in growth rather than a recession.
Tracie, appreciate the update from you. Looking forward to the update again in the next few weeks. Tracie McMillion there of Wells Fargo, not expecting that red sweep, which is why so many of the outlooks were delayed, because a lot of people had to rewrite certain chapters of them looking out to 2025.
Interesting to think about how much people are rewriting them and how much people aren't. And there seems to be an ambiguity around how much they want to actually rewrite them. As we were hearing about from Tom Kennedy, for example, a lot of it was written before the election. But there's a real question, and this goes to Game of Thrones, Succession, whatever you want to say. What are the applications of some of these policies going to be? And maybe, it actually is prudent to wait a bit.
Everyone's worried about prices going up. This came from Target just months ago. Target to cut prices of 2,000 products for the holidays, according to the CEO.
So I just looked at the share price, and it stayed exactly where it was. So it didn't go up. And it goes to Chuck Grom's point, which is that the problem? Is it a prices being too high issue, or is it a product mix issue, or is this them trying to clear the decks so that they can move on? A lot of questions for Target this morning.
Many, and not getting many answers. That stock is down in the pre-market by more than 18%. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. The search for Treasury Secretary continues. Sources tell Bloomberg that President-elect Trump is holding interviews with potential picks Kevin Walsh and Mark Rowan in Florida today. Yesterday, Trump nominated the co-lead of his transition team and once a Treasury Secretary hopeful, Howard Lutnick, to lead the Commerce Department. Scott Bessent remains a contender for the post with reports that he met with Trump at Mar-a-Lago last week. And as you can see there, TJX slightly weaker this morning. It is boosting its earnings per share forecast for the year. The CEO says that customer transactions across the company drove up sales in the third quarter, and its treasure hunting shopping experience is appealing to a wide variety of customers. TJX is also planning to enter Spain with its TK Maxx banner in 2026. Comcast plans to spin off some of its cable TV channels, including MSNBC, CNBC, and USA. The NBC broadcast network, Bravo, and the Peacock streaming TV business will remain with the parent company. Now, according to the Journal, the separated networks produce about $7 billion in annual revenue. Comcast shares are up about 1.4% in the early trade. That's your brief. John.
Hey, Danny, thank you. More from Danny in about 30 minutes' time. Up next on the programme, the morning calls, plus Pierre Fargo of New Street Research previewing NVIDIA earnings, which drop after the closing bell. That conversation's up next. This is Bloomberg. The opening bell around 1 hour and 15 minutes away. Equity futures on the S&P 500 shaping up as follows. We're positive by 0.2%. Let's get you some morning calls. First up, Oppenheimer downgrading JP Morgan to perform, citing lower guidance on net interest income. It's an interesting one. We're down by 0.2% there. Your second call from JP Morgan cutting its HP price target to $41. The analyst expecting in line or slightly softer Q4 results. We're just about unchanged there. And finally, Citi downgrading target to neutral after what they call very poor results, saying it's at risk to lose even more market share to its competitors. Nothing unchanged about this move. That stock is down by 19% in pre-market trading. Let's turn to NVIDIA. The chip giant reporting after the closing bell. Its forecast expected to show whether the world's most valuable company can continue to deliver on AI demand. Joining us now to discuss, Pierre Ferragu of New Street Research. Pierre, welcome back to the programme, sir. Later on this afternoon, after the closing bell, when those numbers drop, what are you focused on?
Well, my focus is actually going to be mostly on how the stock reacts to numbers. We are in a very unusual situation for NVIDIA, where the street, sell-side analysts, in average, expect revenues from the data center business for 2025 at $165 billion. And we think investors, so buy-side investors who follow NVIDIA, own NVIDIA, have already expectations for that business north of $200 billion. So expectations are very, very high. So what we expect to see tonight is a bit all the indicators for NVIDIA are on the green. We think they're going to guide above where consensus is today. And the question is going to be, is this above going to be enough to keep investors in the stock going forward?
Pierre, does it matter why they increase their forecast, which everyone expects them to do, whether it's going to be because they are able to meet demand or whether the demand is just so high that they can charge really high prices, even if there is a bit of a production issue?
Yeah. So in terms of operations, that's exactly what you're pointing at. Demand is still very, very good. We follow very closely pricing and the availability of GPUs in the market, and the market is still very tight. It is not as tight as it was 9 months ago, but it's still very, very tight. There is still room and plans to increase spending. So you see that hyperscalers in particular, cloud players, are increasing their capex steadily, and they will continue to increase. We are relatively confident in that. So on the demand side, the situation looks actually very good. On the supply side, the players, key players, which are Micron, Hynix, and TSMC, are ramping up enough capacity for NVIDIA to continue to grow. Now, all these indicators remain the same. They are 6 to 12 months visibility. And of course, the debate is going to move to what happens in 2026. from now on, much more than what's happening in 2025. So we know 2025 is very good, is going to be very strong. Maybe expectations are a bit too high, but there is no major concern there. What's going to matter is how investor sentiments form about 2026 based on what NVIDIA reports tonight.
Well, and part of that comes really down to what the business model is. Is it entirely for hyperscalers? Is that a benefit as much as people have been worried about that being a possible detraction? The fact that the mega tech companies are the biggest customers and the ones that can't seem to invest enough. Do you need to see in these earnings for people to feel that 2026 is going to be good? Do you need to see a sign that you're seeing a broadening out in the application, a broadening out in the purchases of some of these highest tech chips?
Yes, it is definitely a very important aspect of the story. So you might feel bad about a market in which 5 players represent about half the demand. But if it's a market in which there is only one supplier, it's still actually quite all right. And actually, what we've seen is that other players, like you could say an Apple, a Tesla, and smaller cloud players like CoreWeave or Lambda, and then you have like a very, very long list of additional players who want to roll out their own infrastructure. That part of the market, we expect it to grow at least as fast as the large hyperscalers. And for 2026, investors are, let's say, in demand of more visibility on growth beyond hyperscalers in the market. Yes.
How much you focused also, Pierre, on the regulatory regime and what NVIDIA has to say about how the constraints are being put up around the world in terms of who can get chips, particularly the highest tech ones?
Yeah, so there is a specific point of focus on China. I see that as a relatively small moving part for NVIDIA. It's like the Chinese hyperscaler are 5 to 10% of revenues. China as a whole probably clearly doesn't exceed 20%. And what we've seen is always the same dynamic, which is, getting an NVIDIA chip matters a lot for ecosystem reasons, for compatibility reasons. And so every time there is increased pressure on NVIDIA not to deliver in China the most advanced chip, they can always, scale back and deliver chips that will just match criteria. So we've never seen a significant downside on that front. In the rest of the world, the regulatory or government or geopolitical pressure is only positive, because the pressure is about, I want to have these chips, I want to have these data centers on my territory. That's a sovereignty concern. And that's actually a very strong driver of growth, because usually deployments that are made with a sovereignty concern in mind don't happen through the large hyperscalers and go through smaller players. So that's a very good driver of diversification. And NVIDIA's management is actually playing that card very efficiently. They're doing very well, encouraging these movements and making sure that anyone in the globe looking at deploying locally GPUs have easier access to them.
Pierre, can we just stay on China and talk about tariffs a little bit more? And perhaps could we cover Apple as well? I'd love your thoughts on this. We caught up with Howard Lutnick, who's just recently got the nod to be the next Commerce Secretary. When we spoke to him a number of weeks ago, we talked about the potential for carve-outs for big tech firms if we do slap big tariffs on China over the next year or so. And he said no carve-outs. What was the experience last time around, and how different do you think it might be in the next few years?
Yes, it's a very good question. I would give you two. It's a very complicated question. It's very early in the process, so it's very difficult to make a forecast of or have a firm view. But there are two things in which I believe. The first one is that governments can't really do things that go too heavily against public opinion. And you've never seen China putting excessive tariffs on Apple products, because Chinese consumers love Apple products and influential Chinese consumers love Apple products. So Apple has always been relatively well protected in China. And similarly, when it comes to looking at what the US government and especially the next administration is going to do, that concern is going to be very, very present as well. And it's kind of one thing to say, in that transition period, we're not going to do carve-outs. But then the second thing we know very well is that we've had President Trump as a president already, in the past. And the one thing we've learned about him is that he has a very pragmatic approach to problems, and he's also very concerned about the competitiveness of American companies. So I would be very surprised to see him do some things that generate significant harm to one of our technology leaders.
I'd just like to reinforce that. Are you saying then, Pierre, your base case, your underlying assumption for the next few years is this incoming administration won't do anything that hurts the national champions, the big tech firms?
Yeah, that would be the direction of travel to me, definitely.
Do you think that applies to regulation too?
Well, doesn't hurt the competitiveness of these players. Now, if it's about, reining in like their influence on the public opinion, on the dissemination of information and things like that, that's a completely different story. But doing something that would weaken economically these players, yes, I think based on the track record, based on what we've seen in the previous Trump mandate, I would expect very pragmatic decisions to be made from an economic standpoint, and only from an economic standpoint.
Pierre, do you also think we're going to continue to see export controls, especially on chips that can aid Chinese military?
Yes, of course. There is no reason to see that to see that coming down. And these export controls today are in place, and their effectiveness is a question mark in terms of we still see American ships in Russian rockets landing and blowing up in Ukraine, unfortunately. So implementing these controls is very difficult, but using that as a weapon to negotiate a trade balance between the US and China, and the US and the rest of the world is going to remain a very active very active part of negotiations and conversations, for sure.
Pierre, you've been generous with your time this morning. We appreciate it, as always, sir. Pierre Ferragu there of New Street Research, initially anticipating the numbers coming from NVIDIA a little bit later on, after the closing bell. But just ending there on the prospect of tariffs coming from this administration, what it might mean for some of these major US players. Will there be carve-outs? Will this incoming administration do something that hurts these major tech firms, major American tech firms? The operating assumption, the underlying assumption of Pierre Ferragu is no.
Because ultimately, this is going to be an administration that is governed by the stock market and by the bond market, and these are the national champions. I'm curious to see what companies have to say about that, including NVIDIA, when they report today after the bell.
Up next on the programme, we'll catch up with Matt Luzzetti of Deutsche Bank. We'll speak to Vishal Khanduja of Morgan Stanley Investment Management. All of that just around the corner. From New York, you're watching Bloomberg TV. OK, so we're about 60 minutes away from the opening bell. Equity futures on the S&P doing OK. We're up by 0.2%. On the Nasdaq 100, up by around about 0.25% as well. With 1 hour until the cash open, with your morning movers, here's Manus Cranny. Good morning, Manus.
Jonathan, a very good morning to you. 24 hours ago, we were talking about the strength and resilience at Walmart. When you lose a customer, which is what is happening to Target, when you lose a customer to Walmart, how hard is it to bring them back? And this is what the market is now focused on. They've got inventory that they brought forward. You're going to have to go into a discounting process. And will that bring the customers back from Walmart? The language being used in the Target is resourceful and strategic. That is how they're shopping at Target. Citi said it's a very poor set of results. They marked the stock down to $130. So you're at the money for Citi at the moment. But this is a question of trying to re-grasp those shoppers who have already left you. Roll it over and have a look at Comcast. I want to bring you back to 2011. It was the deal to end all deals. It was Universal, NBC Universal Comcast getting their hands on NBC Universal. The crown jewels then was, of course, the cable networks. Today, we understand there's a spin-off in process, MSNBC, CNBC, and USA. Yes, it's $7 billion in revenue that they will have, and Mark Lazarus will take over. But then it's what's left inside the Comcast family. You're going to have Peacock on the streaming business. You're going to have some sports, movies, and theme parks. And I know you like this. The Real Housewives stays there from Bravo. MicroStrategy. Let's just finish off with this. It's a symbiotic relationship between where Microsoft strategy goes, or MicroStrategy goes, and Bitcoin. We break through $93,000. Not only have they bought another 51,000 Bitcoin on Monday, but they're also issuing notes, convertible notes, to help them, as it were, build the war chest to buy, you got it, more Bitcoin. So they're offering 1.75 billion of convertible notes, and they're going to keep filling the tank with Bitcoin. Jonathan, good morning.
Manus Cranny, thank you, sir. Love Brahmo. We'll leave that there. Let's turn to Ford. Some headlines just dropping just moments ago. Planning to cut 4,000 jobs in Europe by the end of 2027. I've had this conversation so many times over the last few months, just how challenging the auto market is over in Europe, the amount of overcapacity they have, the amount of cuts that we might see. The hits keep coming for the Europeans, and this is another one potentially from Ford.
4,000 positions through the end of 2027. That accounts to about 14% of Ford's European workforce. And this comes primarily in Germany, which we've heard a lot of issues with their auto manufacturing sector, and the United Kingdom. A real question here about electric vehicles in particular that haven't necessarily had the profitability. And it raises a lot of questions. How far have we already seen the cuts, and how much further do they have to go at a time where they're getting sort of double whammied with overcapacity, overproduction, and competition from China?
I don't like to make calls like this, but I'm fairly confident this is just the beginning. This is from Ford. VW is going to be next. We're still waiting for those. Others will follow.
So then there's a question of response from policymakers. And is there any impetus to really come out with the framework, the subsidies, whatever needs to happen? And that, I think, is an open question, what actually needs to happen to revive the sector, and can they do it quickly enough? But in the meantime, this is the reason why people are talking about parity on the euro, and this is the reason why outlooks have been downgraded.
Carlos Tavares of Stellantis said it on this program just a few weeks ago. He said we're talking weeks, not months. You've got to see some kind of policy initiative to stop more of this from happening. That's the latest from Ford this morning, then planning to cut 4,000 more jobs in Europe as the EVs continue to lose momentum. Let's turn to the Federal Reserve. Markets looking ahead to the FOMC's December 18th meeting. Matt Luzzetti and a team over at Deutsche Bank weighing in on the recent Fed speak, writing the following. Most officials' comments leaned at least slightly hawkish, suggesting that the December meeting is a close call between cutting and skipping. Matt joins us now for more. Matt, good morning.
Good morning.
So December 6th, payrolls, 11th CPI, 18th Fed decision. How crucial are those two data points ahead of the Fed?
Look, I think we've seen a Fed that is data dependent. I think almost to the point where markets interpret them as being data point dependent. So I think that those data points will be very crucial for thinking about that Fed decision. But I think if we take a step back and we think about how the economy has evolved since September, the last time we had their forecasts, inflation is coming in higher, the unemployment rate is lower, growth is stronger, financial conditions are easier. And so even if we set aside the election and the impact on the economic outlook that's likely to have, there's probably a pretty credible case for skipping the December meeting anyway.
Fed speak has evolved. Do you think the recent communication is consistent with a pause, with a skip?
I think it's consistent with not being comfortable with where the market had it priced at around 80%. That was just too high, I think, coming into data points. But that a rate cut is still on the table for the December meeting and wanting to kind of have optionality. I think we've heard a few things from Fed officials that's pretty consistent. One, they're in no hurry. Two, with a resilient economy, they can be kind of careful or gradual in assessing this. And then three, one that I think is really important, is that as they get closer to the levels of the neutral rate, wherever that may be, and we could talk about that, but wherever that may be, they're going to slow the pace. And they're probably going to continue to slow the pace. We heard that from Chair Powell at the November meeting, and we also heard it from Lori Logan recently.
I love the neutral rate. It's sort of like a unicorn out there that we never actually see, but we kind of aspire to. And it raises the question of what the parameters are, the framework of growth and inflation that they have over the next few years and how much those are moving based on the recent election. You came out with your outlook and you did change it. You increased the growth expectation for the United States as a result of the election, and then talk about this huge, wide range and potential increase to inflation that some of the policies would have. Can you give us a sense of how much less certain things are now in terms of the economic trajectory than before the election?
Yeah, I mean, they're incredibly uncertain at this point in time. We've gotten the election outcome, so we've been able to narrow down the possible policy decisions. But if you think about the parameters around tax and trade policy, if you think about the sequencing between those two things, those will really determine, I think, what happens from the growth outlook, the labor market outlook, the inflation outlook, and therefore how the Fed responds. I guess ultimately, we do see a backdrop that is likely to lift growth at least in 2025. You're going to get the TCJA tax cuts extended. We're going to have deregulation push. We might get some additional tax cuts on top of that. Financial conditions have eased a lot. All that should really help to support growth. On the other side, you do have adverse supply shocks coming. We do anticipate that you have a trade war, the tariffs are increased, and that will ultimately have an effect. When you look at the impact on inflation, we've benchmarked it as probably being maybe 30 basis points or so next year, another 60 or 70 basis points or so the following year, basically stalling out progress on inflation. But the uncertainty around that is just huge.
Can you talk about that range? You're talking about that the full implementation of tariffs could lift core inflation by anywhere from 0.5 percentage points to 2.5 percentage points. What would that mean from the Fed's perspective? And do you think that that's part of the reason why they're pushing back against some of the most dovish takes on how much they could cut rates?
Yeah, so that was assuming 50 to 60% tariffs on China and a 10% universal baseline tariff, so kind of this across the board tariff rate. And then there's also uncertainty about pass-through. I don't think their more hawkish comments recently is really about what's coming for policy. I think it is acknowledging what's happened in the data over the past several months, the kind of diminution of downside risk to the labor market, inflation being stronger, financial conditions being easy. But I also think as they get to December, they will be thinking about the policy outlook. And I think that because we know from December 2016, they were thinking about that very significantly. So if you go back to the transcripts at that period, I think in the November meeting in 2016, they mentioned fiscal policy 17 times. In the December meeting, it was 212 times. And we know the Fed staff built in tax cuts. They actually raised their neutral rate in December 2016. And so a forward-looking Fed, I think, has to begin to think about how these policy changes are going to impact the outlook.
Let's talk about the fiscal, because you think the priority is going to be the tax policy and TCJA. That's one of the priorities. But you think actually more gets done in terms of the promises Trump talked about in the campaign. Can you tell us what gets left on the cutting room floor and what actually gets put in?
Yeah. So at this point, to be honest, there's just tremendous amounts of uncertainty. It's assumptions at this point. The few things that we think probably could get legislated. One, an expansion of the child tax credit. It's one that does have bipartisan support, and Trump did acknowledge. Two, potentially a modest cut to the corporate tax rate, although that probably comes later, not up front. And then three, there's a number of business tax provisions that have expired that those get renewed, bonus depreciation as an example. It is not anywhere near kind of the size of the tax policy that you had legislated back into 2017, but we have an economy that's already operating quite well. And so it is some additional support on top of that.
We're sitting in New York, so I have to ask, you say no change to SALT. The president came to New York 3 times and talked about SALT. And that has bipartisan support from many Democrats in California and New York. You think that cap stays at 10K?
So it does have bipartisan support. It was one of the key pay-fors in the original tax provision. So one question will be, are there parts of the Republican Party, is it moderate senators, as an example, that do become somewhat concerned about what the impact on the deficit is going to be? Because when you look at the CBO's projections, they assume that the TCJA expired as legislated. And we already had budget deficits that were 5 to 6% over the next several years. Accounting for the TCJA, you automatically have budget deficits that are closer to 7%. We think that that's ultimately what gets passed, but it is possible that you do have some individuals in Congress that do want to have a little bit more fiscal restraint.
When we compare 2016 to 2024, the starting point is very different. And I think it's important to talk about that in terms of the debt, how high it is, in terms of the benchmark rates and how high they are, in terms of inflation, how we don't sort of accept that the issue is getting inflation up. That was sort of where we were in 2016. How much does that change? Just the extent to which, inflation could pick back up, and the importance of understanding how much momentum there already is in an economy that has surprised to the upside again and again.
I think it's crucial, and it's especially crucial for the Fed. So if you go back to 2019, one key reason why the Fed undertook that mid-cycle adjustment of 75 basis points of rate cuts was the trade war. You had the trade war, you had that it was clearly impacting manufacturing, it was shaking global markets, you had a China devaluation that led to the Fed to cut rates. But inflation was close to 1.5% at that point in time. They were worried about inflation being too low, not too high. This is a very different environment. And even though I think that they would like to kind of, quote unquote, look through another inflation shock, if it was a pure price level shock, I'm not sure that they kind of have the luxury of doing so. If inflation is already stalling out at 75, 80 basis points above their target, and we're getting kind of rolling shocks, I would imagine that these tariffs are not going to come all at one time. They're going to come over a period of time. They're going to come in different tranches. And it makes it more difficult for them to identify exactly what's being driven by tariffs.
Looking forward to catching up with you before December 18th. Once we get a little bit more data, December 6th for payrolls, December 11th for CPI. Matt Luzzetti of Deutsche Bank. Thank you, sir. Sticking with the Fed, more Fed speak and data through the week. Today, you'll hear from Governor Cook, Governor Bowman, President Collins. With the latest on that, here's Mike McKee. Hey, Mike.
Hi, John. Obviously, we are waiting on all kinds of data coming up. So we've got NVIDIA earnings this afternoon to keep you busy while you wait for the data to come in. But it is, as Matt points out, a sort of turning point for the Fed. They're trying to convince people now that they have options. They don't want the market leaning into a rate cut because the numbers haven't necessarily been working out as they anticipated, which is why you saw Jay Powell say the economy's not sending any signals. We need to be in a hurry to lower rates. And since then, everybody's singing along to the same hymn book. All the Fed officials who've commented on monetary policy are saying the same thing. Kugler and Barkin are two voters. And you've got a bunch of the non-voters on the open market committee saying that. And that's pushed down the odds of a December rate cut to 59%, still a little bit above 50-50, but nowhere near the 99% that we saw the day after the September meeting when they did that 50 basis point cut. Now they're going to be looking ahead. They're not going to be worried at the moment about what the incoming administration is going to do, but they are going to worry about the data that come in. And of course, as Jay Powell says, it's the totality of the data. Next week, we get Fed minutes, and those will be scrutinized for what they talked about in terms of the future. And then on Thursday, we get a huge data dump. We get everything from jobless claims to GDP to PCE and spending. And the PCE inflation numbers, of course, are what the Fed is looking at. That's their target. And coming after that, the week after that, we get November jobs. And that's going to be really important to that side of their mandate. November CPI, as you mentioned, John, December 11th. The Fed meeting is December 18th. So between now and then, we have a lot of data. And you can expect the futures estimates of what the Fed is going to do to bounce around quite a bit.
And then all over again, as we've seen all this year. Mike McKee, thank you, sir. Joining us now to have that conversation, Vishal Khanduja of Morgan Stanley Investment Management. Vishal, good morning.
Morning.
It's good to see you. We've had enough opinions this morning. Let's just talk about what the market is telling us. Equity's still close to all-time highs. Credit spread's still really tight. The yield curve is still positive, 2s versus 10s. Does that still signal to you a soft landing?
Yeah, absolutely a soft landing. I think the credit spreads are telling you that growth is still going to be very robust. Balance sheets are still very, very strong here. I think some parts of the credit market definitely are Pollyannishly pricing in too much of that sort of positivity coming from 2025, that most of the upside comes from growth and none of inflation doesn't show up. That is where we are slightly pushing back on some parts of the credit market. But overall, we do think that the repricing from 250 basis points of cuts, probably right after the Fed cut 50 basis points to barely about 3.5 till end of 2025. I think it's U.S. economic resiliency and a little bit for the Republican sweep that we've seen.
So you talk about a soft landing, and I feel like we need to identify what a soft landing is because I'm losing track of what a soft landing, hard landing, no landing is. Amid the alphabet soup that we've had, are we talking about inflation getting back down to 2% on a consistent level over a long term without there being any further real disruptions when it comes to interest rates? Interest rates by the Fed coming down pretty steadily, and then everything can move on.
I think that paints a fantastically smooth line down. I don't think that the line is going to be as smooth as you painted it. It's going to be a bumpy one there. We do think that inflation is going to come down. I don't think that we'll be able to repeat the pace of decline that we saw in 2024. I think we saw a little period in end of 23 where the inflation drastically came down. Fed acted, communicated, and then acted finally. 2024, there were periods of nervousness from the inflation again picking up. We, I think, will completely see that in 2025, a bumpy line down. And yes, I think we need to acknowledge what's happened here in the U.S. in terms of the election results. The Republican sweep does change a lot of it here, and a lot in the sequencing, the amount, the magnitude, and actual implementation of their policies affects inflation as well.
So guest after guest this morning has come on and talked about how the bond market's going to be the ultimate arbitrator for the policies of this administration, and that basically the reason why yields might tick higher on the long end on any given day is because of who's in the lead for the running for the Treasury Secretary. How closely are you watching all of the incremental moves when it comes to day-to-day expectations for longer-term Treasury yields?
Watching very closely, but it's not acting on every headline. I think we do need to see that first, second quarter of 2025, when these people actually come into office, actually then have to effectuate policy with the amount of deficits that we are sitting in. So yes, bond market is going to be a fantastic barometer of what the new administration can actually accomplish.
Well, we heard from the former Treasury Secretary, Larry Summers, talking about the bond market will educate lawmakers. We have potential contenders. Maybe in the next 24, 48 hours, we'll find out who is going to be the helm of the Treasury. How important will this bond market be for that person?
Super important. I think those are huge shoes to fill if you think about it. Like the entire election sort of campaign was based on it, because the numbers are easy. Math is easy. It is very easily telling you it's not sustainable at the pace that we are about to head on into 2025. Not all those policies are going to be implementable with the amount of deficits that we are sitting on. So the math is very clearly easy. Politics and implementation is what is difficult for 2025. So yes, I think the person who takes on that role not only has to effectuate that policy, but then bring all these sides of this argument together and then sequence it appropriately throughout 2025.
Just quickly to get to the credit call. These risks are why a lot of people are underweight duration and worried about being in treasuries until we get clarity on that. Yeah. But then they're overweight credit. Mm-hmm. At what point does one compromise the other?
I think if inflation starts to take over above growth, I think that is where the combination of those two and which one actually starts to perk up first. Typically, I think just CFA and Fobosi would tell us probably growth comes and then inflation as a beta follows up after that. But I think if inflation picks up and we start getting worried, or the market starts getting worried about stagflationary type of environment, I think that is where credit starts to break down.
That is a real dilemma potentially for any central banker. Appreciate your time, sir. Thank you. Vishal Khanduja there of Morgan Stanley Investment Management. If you are just joining us, welcome to the programme. Let's get you an update on stories elsewhere with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Ford is looking to eliminate another 4,000 jobs in Europe by the end of 2027. Those cuts amount to roughly 14% of the workforce there and will primarily affect the UK and Germany. The move comes with the EV transition losing traction. Competitors, including Volkswagen and Stellantis, have offered profit warnings in recent months, citing slowdowns in sales and governments pulling support for EV purchases. Bitcoin has soared to another all-time high. The cryptocurrency surpassed $94,000 today, still above that. More than 350,000 contracts changed hands after the Nasdaq-listed BlackRock's iShares Bitcoin Trust yesterday, and 80% were bullish bets. For Delta Airlines flyers, that pricey first-class airline ticket will soon come with a new perk. Delta is partnering with Shake Shack to offer cheeseburgers as in-meal flight meals starting next month. The burgers will be available to first-class passengers on over 900-mile flights out of Boston, with more markets to follow next year. It's the first arrangement of its kind since United partnered with McDonald's back in the 90s. That's your brief, John.
I do not want to smell fast food on planes.
I was just thinking that
one person that comes on board with McDonald's.
Yeah, with fries.
And you can smell it.
But I love Shake Shack.
Okay,
for 2 hours.
Honestly, but it's also, you're sitting there, you don't want to feel like, ugh.
They have gluten-free buns.
Everyone else can do whatever they want. I just don't want to smell it. They can eat whatever they like. I'm not going to please
PSA
that.
from
Free world.
Fargo.
I just don't want to smell it. Up next on the programme, we'll set you up the day ahead. Looking ahead to earnings from NVIDIA. The open about 37 minutes away. The calendar looks like this. Today, Fed speak from Cook, Berman and Collins. NVIDIA reporting after the closing bell. Thursday, another round of jobless claims. And some remarks from Goolsby on Friday. S&P Global PMIs and UMich consumer sentiment. Joining us around the table, Bloomberg's Mandeep Singh. Mandeep, good morning. A look ahead. Give us some things to watch a little bit later.
I mean, with NVIDIA, clearly, I think you will see a very good top-line number. The question is, last quarter, there were concerns about gross margins peaking. And, with the incoming administration, everything looks positive. But if they impose higher tariffs, the impact of that in terms of component costs for NVIDIA and what that results in terms of gross margin guidance, I think that's one to watch out for. And in general, I think power, as I mentioned earlier in your show, it is one of the biggest constraints right now in terms of scaling generative AI. And who better than NVIDIA to answer that question tonight?
So what specifically do you want them to answer when it comes to energy, just in terms of how quickly their chips can process or whether they can come up with a chip that can get around that constraint?
Yeah, power efficiency is a big theme with the Blackwell release they're talking about, and everyone wants to know if they actually ship Blackwell and how much revenue did it contribute in the quarter. The other is if the clusters are getting bigger, 100,000 or even bigger, how do you supply power? I mean, look, the companies are already raising their capex. We are in a capex super cycle, granted. But the question is, how does those chips come online in terms of actually providing the compute for training? And you need that power. So that's the kind of the bottleneck that no one actually has thought about in terms of scale. People have acknowledged it, but how do you practically solve that problem? And I think that's where the nuclear option or some of the bigger power plants have been discussed. But I think NVIDIA probably has the best insight.
Mandeep, quickly, what's the bar? Is inline enough?
No, I mean, people have become so less sensitive to NVIDIA when it comes to valuation. 20 times sales isn't sustainable if you're not growing 50% or plus. So in this case, everyone is modeling 50% growth for next year. So it's all about how much are they going to go in 2026, whether it's going to be 25%, 20%, or lower. And that 20% sales isn't sustainable if you're not growing that much.
Lisa had the line of the morning earlier this morning. We were worried about nuclear war yesterday, and NVIDIA was still higher by 5%. So that's how much confidence people have in NVIDIA. That name is up by 200% so far year to date. Mandeep, it's good to see you, sir. Appreciate your time. Mandeep Singh of Bloomberg Intelligence. You'll hear from Mandeep tomorrow once we get those earnings later on this evening. Coming up tomorrow, we'll catch up with Cameron Dawson of New Edge Wealth. We'll speak to Aditya Bharve of Bank of America, Gargi Chowdhury of BlackRock, and the IBM Vice Chair Gary Cohn on the race to be the next Treasury Secretary in the United States of America. Live from New York City, thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.